This is Bloomberg Best, your weekly review of the most important business news, analysis, and interviews from Bloomberg Television around the world.
Ken Burns, welcome to Bloomberg Big Decisions.
We have always been a mixture of things. We are always stronger for that mixture.
Growth is a way to stay competitive, delight more and more consumers.
Welcome to the Best of Bloomberg Technology. I'm Emily Chang.
They move the needle by acknowledging that they have to monitor the content.
What is one word of advice you'll take with you?
Learn how to listen. And that is certainly something that has served me well.
Ankiti, where do you go from here?
It's a huge market. It's a huge opportunity. I want to go 100x from here.
Our philosophy is to partner where we can and stand apart when we should.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Fees that retailers had to pay to be able to enter the markets, the democratization of the markets by allowing them to have direct access to the markets over the last 10 to 20 years has really been, a key trend that has driven, I would say, the U.S. markets.
Bloomberg Surveillance, Tom and Francine from London and New York. Tom, we're having a good conversation about the U.S. economy with Andrew Hollenhurst, Citi Chief U.S. Economist. Andrew, we were talking a bit about the reserve currency. We talked about savings. Is there anything that you worry about in terms of companies going bust, of bankruptcies? Is this the one thing that actually we really don't know where the knife will fall and could completely reshape the U.S. economy?
So bankruptcy and liquidity issues is something that we still worry about quite a bit. I would say probably actually more at the household level than at the business level, although balance sheets look quite strong amongst households. And for businesses, you've had significant Fed programs as well as access to liquidity in the private markets. So really a lot of those concerns that we had back in March and April haven't come through because we've seen corporates that have been easily able to source liquidity. The concern, though, is because a lot of this is due to government programs, to what the Fed is doing, there's a concern that maybe you're papering over some of the real problems that are out there. So I think Tom mentioned earlier, perhaps you've been able to make your rent payments. Now some of the unemployment stimulus checks are going to go down in level. Maybe you were part of a forbearance program where you didn't have to make those rent payments. So as those payments come due again, do you have kind of a lagged wave of bankruptcies? Again, we don't see that in the data yet, and I don't know that that's going to necessarily be a major negative in the next few months, but definitely something to be watching for.
Andrew, when you look at some of the big companies, Amazon, some of the tech companies, but actually I'm thinking of Amazon in particular. How will they change the U.S. economy as more companies, maybe in retail will go bust? Are they just going to be ever more present?
I think that's right. And one of the things that we're really thinking about here from the economic perspective is this movement from more labor-intensive businesses to less labor-intensive businesses. So maybe we're still going to be doing the same amount of retail sales. And in fact, in the data, retail sales is essentially back to where it was pre-COVID. But if a lot of that activity is moving to platforms that don't require going into a retail store, don't require interacting with somebody in that retail shop, then those jobs are not there anymore. So that's a big concern.
Andrew, do you have a percent of GDP that we've stimulated so far? I mean, we've got different parties saying we do or we do not need state and local aid, et cetera, et cetera. Do you have an all-in percent of GDP that we've provided income assistance to?
Yeah, so this is one of the largest stimulus programs that we've seen, and that's appropriate. We just had the data from Q2 GDP, and we saw this significant contraction. So we're looking at something like a 10% of GDP stimulus, and now we're talking about adding to that. And I think I and many economists would say that's completely appropriate given how much the economy has contracted.
Andrew, thank you. Well, let me do this. I guess we'll do more, Andrew, here. We'll see where we go on that. Let me look at the data right now. Up 3, negative 15 on the Dow futures. NASDAQ futures continue to advance, and that really gets my attention. Of course, we've had the Google news break of a 7% ownership in ADT in security in Florida. That may have a little bit to do with the oomph in the market. Let us come back. Robert Kaplan to join us later of the Dallas Fed. This is Bloomberg. Good morning.
Decision came pretty quickly over the last 4 months. Once the lockdown happened, we decided we no longer wanted to be in an apartment building and we wanted to have a little bit more room for our family.
I think the pandemic really caused the glue to hold the commitment we had to Manhattan to fall away, because since the banking and the technology companies have said to their people work from home, there's no need for us to be there to service the mass population. Right. So if everyone's working from home, we will too.
Hi, Gassim. You need to check our playlist, our channel. If you will go to SG Trader, you will see it's not how often we trade. We're open from 8 o'clock until 10 o'clock every day. So basically, this is live day trading channel. It's not like we provide like 3 or 2 hours. We're working when basically market is open. This is live trading channel, okay? Go to SG Trader, it's all written on description. Go to SG Trader, click on playlist, channel, and you will see basically all sessions, all extracted videos for our customers, everything you need to find over there, okay? If you have any more questions, just don't hesitate, just ask us, yeah?
I'm David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
This is Bloomberg Surveillance. I'm Ritika Gupta. Let's get the Bloomberg Business Flash. The Japanese owner of 7-Eleven convenience stores has agreed to buy Marathon Speedway gas stations for $21 billion. 7-Eleven is betting that an expanded U.S. footprint will deliver growth in the midst of the pandemic. Marathon is joining other energy companies in getting out of the retail business. It's the biggest medical acquisition of the year. Siemens Healthineers has agreed to buy California-based Varian Medical Systems for about $16.4 billion in cash. That represents a 24% premium to Varian's closing price on Friday. The purchase would boost Healthineers' presence in cancer treatment. And HSBC is warning that loan losses this year could hit $13 billion. Europe's largest lender posted second quarter profit that fell by more than half. Earnings slumped at HSBC's retail and corporate banking businesses. That was partly offset by rising income from the market division. And that's your Bloomberg Business Flash. Tom Francine.
Ritika, thanks so much. On a Monday, we have right now a real ability to have an extended conversation with Andrew Hollenhorst, Citigroup chief U.S. economist. And Andrew, what I want to do here is really focus on the theories that are out there about what a central bank will do given what the market says. The markets are pricing bonds, bills, and notes to perfection. They're pricing inflation securities to perfection, like the 10-year tips at a negative 1.01, just extraordinary and unimaginable. Can the central bank actually control what the market does and believes and expects?
I think it's certainly something where they can nudge the market one way or another, but ultimately, and we've seen this over the last few years, the market is going to have the market's expectations about what the central bank is likely to do, and it becomes very hard for a central bank to push back in a significant way.
You nail this. I love your word, nudge. Okay, so I guess we have a guesstimate of what Chairman Powell and the smart people at the Fed can do to nudge, but that only gets them so far. How many basis points of nudging do your experts feel they have? What's the band of nudginess that they have?
I think it's very limited right now in terms of trying to provide further accommodation, trying to push rates even lower. We just had in the press conference following the FOMC, Chair Powell saying, not even thinking about. We had three thinkings abouts before you were going to get to actual rate hikes. And that's essentially what the market is pricing right now. So there's a sense in which markets and the Fed are very much on the same page with low rates for an extended period of time. But can you do something to kind of marginally push rates lower? Very hard in this scenario.
Andrew, if the U.S.-China trade war, or whatever it is, because it's not even a trade war, just like, fights on intellectual property and things like that gets worse, how much will that shave off U.S. GDP?
So it really depends on in what way things transpire. And that's, I think we actually, it's a great way that you said that, Francine, because we had a lot more clarity about what these disputes meant for GDP when we were talking about trade specifically. And we kind of had some framework around it where we thought, if things go more negatively, you're going to have higher tariffs. We know how to model that. We're really into unmodeled territory, or territory that's very difficult to model here, because these kind of flare-ups around certain issues that maybe we weren't expecting, and then we don't know exactly how those map into the economy. So I think the honest answer is no one can really tell you how this maps directly to GDP, but certainly a negative if two of the major powers in the world are having disputes.
Andrew Hollenhorst, thank you so much for the extended conversation. Greatly appreciate it with Citigroup today. Now we go to the fixed income market, really on the same host of questions with George Bory of Wells Fargo. We're thrilled he could join us here on short notice. George, I look at where the TIPS 10-year yield is. Just simply, what does that signal of the belief of the market and the commitment of the market to force the Fed's hand?
Yeah, good morning, Tom. Good morning, Francine. Thanks for having me on the show. Really, really appreciate it. It's good to speak with you this morning. I mean, as you point out, the fixed income markets, I think, it's giving you two messages. One is economic, and I think the message here is the economy clearly is still in a very weak spot. And as we saw in last week's data, inflation or deflation is still very much a risk. The Fed's very far from its central targets, and the bond market's telling you that they still have a long way to go to get there. The other is just Fed policy. The market believes in the Fed. They believe that the Fed is going to do more, and that the Fed has to do more in the upcoming sort of months and quarters. And that's pretty much what Chairman Powell suggested last week, that they plan to do more, and that's really what's coming through in the bond market.
What is the band of control that the Fed has? We just talked to Andrew Hollenhorst about this, and that where I see where real yields are, or even the nominal yield, 2-year 0.1073, what is the almost efficiency or efficacy that the central bank has around that statistic? Do you have a gradation of how wide that collar is?
Well, I think the band is I think they're looking at it in from two perspectives, again, and another two perspectives. One, I think, is just the volatility structure around fixed income and fixed income prices. And I think that's where they've been very successful this year. They've pushed down volatility back in March and April, and they've been able to control vol over the course of the remainder of this year so far. And if you look at, say, any of the implied vol statistics on fixed income, they're back to pre-COVID levels, and they're actually back to just about all-time low levels. And again, I think that's just through sort of their intervention and their ability to kind of take down kind of market expectations, provide sufficient liquidity, and kind of re-engage markets. Now, your point about real yields is concerning, and this is where they have a real challenge. You know, if yields are going to, if inflation is going to stay low for an extended period of time, then the market would tell you that they need to bring yields down even further. And as you know, as we kind of approach zero, that's going to become increasingly challenging. Our expectation is the Fed does not want to and does not intend to take Fed funds negative. And so the market, I think, is testing the Fed's resolve in here to say, what else can you do to kind of help the economy? Interest rates are one, but pass-through mechanisms are another, and then that's really where perhaps the Fed will have to sort of, try and extend its control, because it's not just financing the federal government, it's financing everyone else. And they have been able to bring down yields, but real yields are still relatively high for private borrowers.
So, George, what can they do to give a clear message to the market?
Well, I think they're doing some of that now. I mean, they're using forward guidance. They're kind of telling you they're not changing rates anytime soon. They've extended their credit facilities, both the purchase programs as well as the repo agreements, repo arrangements, and I think that they're sort of kind of trying to jawbone the market here, for at least for the time being. The next step would be, would they want to try and implement some sort of curve control? Again, I think they're kind of a little bit in wait and see mode. But to the extent they shift their policy framework and they're sort of targeting kind of a flexible band around inflation, that gives them a little bit of wiggle room, but not a lot. And so, they are kind of full pedal to the metal right now, and I think they're going to have to stay here, convince the markets they're going to stay here, and then kind of continue to wait for some of that kind of liquidity to filter through. At the end of the day, they can support the banking system, they can liquefy markets, they can provide the liquidity to sort of engage, but they can't change federal policy, they can't trade fiscal policy, and they can only do so much on the economy. They can grease the wheels, but they don't build the wheels, and I think that's really kind of one of the issues here.
George, what happens to inflation in the U.S. 18 months from now?
That's a great question. It's difficult to tell. Our expectation is that, inflation kind of bottoms here and will start to recover. Our central view is really kind of built around, we call it we're calling it a dog leg recovery. If you think of the shape of a hind leg of a dog, it sort of snaps back sharply, and then there's sort of a very gradual kind of recovery, which is unfolding. Our view is that the economy is adjusting. We're starting to live and learn how to live with the risks of COVID kind of across the economy. That should help, that allows growth to start to kind of pep up just a bit. Inflation should start to come off of the very, very low levels or deflationary levels we saw in the second quarter. And so we're not calling for a deflationary kind of decline, but we are calling for very low inflation, for an extended period. And that does reach out well into next year and out until, 18 months forward. So below what we would call below target inflation, at least for the next 1, possibly 2 years.
George, thanks so much. George Bory there of Wells Fargo Asset Management. Now let's get straight to the Bloomberg First Word News in New York City. Here's Ritika Gupta. Hi, Ritika.
Hi, Francine. Bloomberg's learned that the White House has given Microsoft and TikTok 45 days to work out a deal. Microsoft is trying to salvage a plan to buy the U.S. operations of the wildly popular Chinese maker of wildly popular music videos. At one point, President Trump had floated the idea of banning the app outright on national security grounds. Microsoft CEO Satya Nadella spoke to the president yesterday to try to get his blessing for a deal. Minneapolis Fed President Neil Kashkari is urging Congress to do more on the coronavirus and the economy. Kashkari told CBS the surging U.S. savings rate means that the country can afford to support Americans who are out of work. He also said that a month to 6 week lockdown could lead to a faster economic recovery. And a warning from White House coronavirus task force advisor Deborah Birx. She told CNN that the U.S. is in a new phase, saying the virus is extraordinarily widespread across rural and urban areas. Birx said that America is on the move during the summer vacation and the public needs to take more precautions. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Ritika, thanks so much. Whatever your politics, it is an extraordinary moment, an extraordinary early August in Washington. On and on we go with this great debate of aid, welfare, income assistance, however you want to phrase it. Here is the Secretary of Treasury.
We have to balance. There's obviously a need to support workers, to support the economy. People who, through no fault of their own, are shut down because of this terrible disease. On the other hand, we have to be careful about not piling on enormous amounts of debt for future generations.
Mr. Mnuchin, after an eventful weekend including visits on Capitol Hill, we could talk to another talking head. Instead, we'll actually talk to somebody that gets policy and gets the operational details of how policy is made in the marble halls of Congress. Henrietta Trez is with Veda Partners. We're thrilled she could join us this morning. Henrietta, what goes on in those rooms? I mean, if it's $600 a week or whatever, and somebody wants $0 a week, David Kelly over at J.P. Morgan says, split the difference. Why is there no splitting of the difference?
That's a great question. Thanks for having me this morning. I think right now they're just talking about how long are we going to have these benefits in effect? Should we re-up them? Is there an ability to have it tethered to your income prior to COVID-19? There are so many debates right now happening around just the parameters. What can we even have a conversation about? That discussing $600 or $300 is probably at least a Tuesday, Wednesday event, which is a lifetime in D.C. But for right now,
Henrietta, there's photos of the food kitchens in New York and every other town and village here. 30 million people don't have a check, and we're waiting for Wednesday?
That's exactly right. And that's exactly what Speaker Pelosi would say to you. Hey, we passed this bill in May. The Republicans in the Senate have barely come to the table yet. What are we waiting for? There is a profound disconnect between the realities that people are facing on the street, whether it's at food banks or imagine if you're a family and your kids are getting their school canceled. You have to plan for that a month from now, or in the case of New Orleans, where I am, 2 weeks from now, and you have absolutely nothing to go on from Washington, D.C. And the question is more, are we going to get a bill in August or September? And that's our biggest debate right now. And one of the things that's a struggle for all parties involved is that there are somewhere between 15 and 20, per Majority Leader McConnell's own remarks, Republicans who will not be voting for any legislation. So talking about $600 versus $300 is a while away from figuring out, hey, what can we bring to the floor? What is even remotely possible to get through the Senate? And Speaker Pelosi and Minority Leader Schumer don't know who they can negotiate with. So right now there are discussions between the White House and the Democrats, but that leaves out the Senate Republicans, and they are a critical voice here. And what we really need to see is for Majority Leader McConnell to get in a room with Speaker Pelosi and figure out what they can do. And we're not there yet.
Americans are going to vote in November. Who will they blame this on?
Right now, it seems pretty plain that they're blaming President Trump. His disapproval and his popularity decline coincides almost exactly with the outbreaks of the coronavirus, with the Black Lives Matter movement, and with the downturn in the U.S. economy. So it seems like certainly no one likes anybody in Congress. Congress routinely has, somewhere in the teens approval ratings, but President Trump is really being dealt a tough blow here with this, and that's working to the advantage of his Democratic challenger, Joe Biden.
So how do you think this will be resolved, and what kind of timeline?
My optimistic approach here is that with 75% odds, we'll get a bill sometime in the next 2 weeks. We held a conference last week for our clients, or 2 weeks ago for our clients in D.C., talking with Democratic leadership, and they suggested that the only deadline they really have is the convention. So that's August 17th. For me, I'm always looking for a deadline in D.C. They only operate at the 11th hour. So August 17th, if we don't have a bill by, let's call it the 14th, we're probably not going to see something till late September. As you and I both know, that's at least 6 weeks of no unemployment insurance benefits, a lapse in the eviction moratorium, and there is more aid that's needed for restaurants and you name it, the whole entire tourist industry. So the main question is, when are we going to get this bill? I think it's near a certainty that we're going to get something. And if we don't get something in August, then we're going to be in a dead zone. Obviously, the employment data comes out on Friday. That's a critical date. I think that could move the needle. So if we don't get a bill this week, that should pressure members to come to the table next week. The Senate is supposed to adjourn on Friday, so I'm hopeful that they would stay in. But there is a lot of work that needs to be done, and they're very far away. As Tom mentioned at the beginning, they're not even in the same room together having a conversation right now.
Henrietta, what percentage in some of these Senate districts, these Senate states, these Senate cities, villages and towns, what percentage of people can't pay the rent this August 1st?
That's the question, to see what the employment data is going to be. One of the things that we had to deal with is the PPP providing a substantial amount of weeks of requirement that you keep 80% of your employees. And I was just talking with some friends about this last night. That expired in June. So the July payroll numbers should be probably much lower than they were in June, which was artificially inflated or inflated because of the fiscal policies that Congress and the action Congress took at the end of March. So we have this drop that's going to be driven by a lapse and an expiration of the PPP employment mandate, and that is going to have a tremendous impact, and I suspect will meaningfully rise up the employment data that we see, the unemployment data that we see on Friday. So that is the key question to me. One of the things we've seen from lawmakers historically is that they respond much more to macro data than they do to any micro data that you can see week to week. So I really am waiting for this. I wish it would come out today just to spur some action, frankly.
Henrietta, what should be the number, the one or two priorities that need to be in this bill?
Unemployment insurance benefits is the absolute number one. You have to get that extended. If you do the math, you're talking about maybe a $50,000 a year salary just from the unemployment insurance benefits. That's kept the consumer afloat, which, as you know, is 60% of the U.S. economy. You've got to extend that. That's probably the number one piece. Aid to schools is a really big component. Child care is a big piece. State and local governments, the business liability piece is tremendous. They're all really important issues, but unemployment is number one.
It's really interesting, Henrietta, that you're at 50,000 there. I eyeballed the wonderful work of Ella Coez of the New York Times last night, and it came up with the number 44,000. So it's right around that point where the kink is in the curve. This has been brilliant. Henrietta Trays with a great update there on where America is in this economic slowdown and pandemic. Coming up later, Catherine Mann of Citigroup. This is a really important conversation. We'll go more international here with Dr. Mann, as we went with her colleague Andrew Hollenhorst a bit ago. Catherine Mann of Citigroup. Worldwide, we do that in the 8 o'clock hour. This is Bloomberg.
has been interrupted. Uninterrupted service is peace of mind. Juzi from customer support is responding to a 500% increase in daily call volume, no matter what. We keep on, so you can keep on.
The crisis has been peaked in April until mid-May. The good news for me is that since mid-May, we see a significant and encouraging rebound of all our businesses, and including in our global market activity, as you just mentioned. And our equity business, which has been the most impacted in the first quarter and at the beginning of the second quarter, is rebounding since mid-May today.
There is a pickup in activities. It is a bit stronger in some, maybe a bit slower in others. That's a dynamic that you see. And so, as we said, if you look at the overall pickup, we see it, but before it is back to the level of pre, we don't think that to happen before mid-2022.
Oh, Nassim Taleb, where are you? They've been fooled by randomness, or maybe it was the black swan of this horrific pandemic. But all in global Wall Street are dealing with it, and particularly the banks are dealing with it, and they're dealing with it in the derivative space. And that, of course, means the French banks. Jonathan Tice joins us on the French banks and then also on HSBC as well, with decades of experience. John, you and I have seen this before. It's a two-part structured product, a bond obligation, typically a zero coupon bond, a lock in the principal, and then there's some form of optionality until it doesn't work. Give a pandemic, it doesn't work. Why were we surprised at the SocGen losses?
Well, I think the headline losses are more to do with the goodwill and deferred tax asset write-down. If you look at the underlying run rate of the equities trading, it's a little bit worse than consensus, but not that bad. And then clearly the focus of the call, which is going on at the moment, is very much, okay, so you guys are restructuring, that makes sense. You say 200 to 250 million revenue hit through 2023. Where does the 450 million euros of savings come from? So the headline loss, don't get overly fixated on that. But where is the equities business going to be for SocGen? Because it was a very, very important part historically. Yeah. Clearly, they've had quite a lot of pain over the last 2 quarters, but they're also saying on the call, actually, the rest of the underlying business is fine. So they're just going to switch back to far more plain vanilla business.
Yeah, you and I have been here, 8 times, John? The siren call of derivatives is just what it is. Is this just a 2-year exercise and then they bring back the derivatives of business just because of the greed of derivatives, the desire for all the revenues, all the fees? Is it almost a cyclical event?
I don't think so, no. I think that the banks, once again, with sort of greater transparency and the fact that Natixis had a blow up in 4Q18, they've had a 1Q and 2Q blow up. SocGen are there, BNP had pain. The market is that much more aware of this now than it has been. Investors are, and they've underperformed hugely. So I kind of wait till the market's looking the other way and try and grow back into this business. No.
Jonathan, what do they need to do with the equity structured products? I mean, they have a leading position in that. Will it be affected by some of the changes that the chief executive could put in place?
Oh, I mean, absolutely. But I think we have very little visibility on what the underlying risks are from the trading assets and the business that they write. What they're going to do is, I assume, go very much more plain vanilla, a lot more flow products, ETFs, that kind of thing, the businesses that they have through Lixor, and probably stop being quite as adventurous, guaranteeing dividends and that sort of thing.
Okay, but if you're an investor and you have BNP Paribas and Société Générale, which one seems more attractive right now?
Well, obviously we can't have a view on kind of valuation, but in terms of earning strength, visibility of pre-provision operating profits, BNP wins hands down. Because they've had the same problems in equity derivatives, but have we noticed it? Not really, because they've got a huge fixed income beat, up 150-odd%, and they're that much more diversified. So SocGen has underperformed significantly, and I guess people will be looking at thinking, can we draw a line under this now? Is the stock now cheap? and will they deliver on promised cost savings? But from a visibility and sleep at night perspective, I mean, BNP has become the kind of HSBC, as was, of a core holding of whichever banks long-only guys do have in their portfolios.
Is the chief executive's position safe? I don't know, Jonathan. I mean, there are a number of banks looking at replacing people at the top. I think he's one of the longest-serving European bank executives.
I think he is the longest serving now, actually, and we've written about this in the past. And you certainly look at kind of delivery and performance over the past 10 years. I think he's been there about 10. I would have thought no. I mean, if anything, the next stage of SocGen's life is a digital transformation continuing, more focused on the retail franchise. And will he be here in 3 years' time? I'd be very surprised. Because a little bit like Lloyd's, a little bit like we've seen a shift at ING, UBS, etc. The digital world is a very good excuse for banks to revisit management and bring in some fresh blood.
Jonathan, thank you so much. Jonathan Tyser, Senior Banks Analyst for Bloomberg Intelligence. Now, up next, Dr. Joshua Sarstein. He is a Johns Hopkins University Vice Dean for Public Health Practice and Community Engagement at the Bloomberg School of Public Health. We'll talk COVID-19 shortly. This is Bloomberg.
Fiscal policy actions that have been taken thus far have made a critical difference to families, businesses, and communities across the country. And it will take continued support from both monetary and fiscal policy to achieve that.
The Fed really can't stimulate the economy very much when people don't want to borrow and businesses depressed and so on. What they can do is make sure we don't have a financial calamity on top of the real calamity, which they've been doing very well and will continue to do. We need fiscal support.
It also is a very important step in dealing with inequality, ultimately inequality and the institutional biases that are baked into the cake of our economy.
I wouldn't be surprised if we did get the scenario Tom and I were talking about, that the market would just take over and drive interest rates into negative territory even without the support of the Fed.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
This is Bloomberg Surveillance. Tom and Francine from London and New York. Now, as we continue to track the virus, Bloomberg has developed a unique partnership with the leading authority on COVID-19. Johns Hopkins has been at the forefront of the international response, and every day we bring you insight from experts in public health, infectious disease, and emergency preparedness. Well, joining us now is Josh Sharfstein. He's at Johns Hopkins Vice Dean for Public Health Practice and Community Engagement at the Bloomberg School of Public Health. Dr. Sharfstein, we often focus about the U.S., but actually there's a number of cases rising in a number of emerging markets, but also Japan, emerging markets such as the Philippines and Vietnam. What do we know about where the number of cases increased significantly?
This is a major concern. I think the world is hitting records in the total number of coronavirus cases. So we are really in the thick of the pandemic, and we're seeing surges in the Philippines and in Vietnam, which have not had serious coronavirus outbreaks to date, and even Japan has had the highest number of cases that it's reported. I think in Japan, the answer is very clearly that they completely opened up. They acted like the virus was behind them. That is a mistake that every single country in the world will make at its own peril. In the other countries, they had been almost completely spared at the beginning, and people wondered, was it some, special thing? It probably was just good, little luck and very good public health work, and they're going to need some of both probably to get this under control.
So how should we be looking at this? Is it better to be in full lockdown for a shorter amount of time to save lives than a kind of, open, not so open phase for longer?
Well, I think the story is a little different between the different countries. I think a lockdown is necessary to really, control the spread. And then when it comes way down, you can't stay locked down forever. You just have to be prepared that a loss in vigilance or even some bad luck will lead to a resurgence. And then you have to be able to have the capacity to respond to that. And so we're going to see the public health systems of Vietnam and the Philippines tested. And that's not just locking down. That's all the tracing, all the testing, all the things that have to happen. I think Japan, even though it is having a surge of cases, should be able to respond to this. There's still relatively very few deaths in any of these countries, and if they can respond effectively, they should keep this down. It is not surprising that we'll see these surges from time to time. The key is whether people can beat them back.
Are the winter months in the Northern Hemisphere going to be much worse?
From the United States perspective, it's getting hard to imagine much worse because, the virus is in so many places rising so quickly, and our rates are so high. I think that it's possible that it could be worse, particularly as flu comes. If we're able to control the coronavirus through distancing, the flu season may not be so bad. On the other hand, we're not able to control the coronavirus through distancing, so we may still have, it may be even worse with the flu season. So, we don't know. It wasn't that long ago that people were saying, I think the summer's going to be way better. It's very hard to predict with this virus. I think we just need to be focused on the severe situation we're in right now.
Okay, what drugs work to try and cure the sick, and which ones don't?
Well, the drugs with evidence are the remdesivir, steroids. There's an inhaled immunomodulating drug, and we know that hydroxychloroquine and azithromycin do not have evidence for them at this point, and shouldn't be used. So it's and I would say that the other thing that has a growing amount of evidence and may be even more widely used soon is convalescent plasma, using the antibodies from people who have recovered to treat. And there's some definitive studies that are happening now, but there is emerging evidence from repeated studies of benefit there.
Joshua Sharfstein, thanks so much for joining us. He is, of course, of Johns Hopkins, and be sure to check out VRUS Go on the Bloomberg for the latest information. You can also tune in every day for exclusive conversations with Johns Hopkins experts. Coming up, more Bloomberg surveillance, this time simulcast.
guidance from the World Health Organization.
It's humbling, and it's incredibly exciting in terms of anything that we've done, so far as a company. Florence isn't trying to trick you that she's a real person. Florence is saying, I'm a digital person, I'm here to help. Florence is digital, there is no judgment involved. So the lack of human judgment actually makes our digital people more approachable and potentially more helpful.
The Boston Symphony Orchestra presents BSO at Home. While you stay inside, enjoy a curated collection of archived concerts and behind-the-scenes stories from BSO musicians. BSO Homeschool provides lessons for music lovers of all ages. New performances and messages from musicians are added regularly. Enjoy these selections and much more at bso.org/at-home.
Other tools such as income tax would require a lot of time to prepare, because if you don't have the base, this will take time. So whatever we are thinking about, we think also about implementation and ease of implementation.
The stock market's become less and less representative of the real economy, and you still have arguably the greatest divergence between real economic outcomes and the stock market.
I don't think we're going to fall off again. I don't think it's a W-shaped trajectory. It's not going to be a downturn again.
What we're getting now is evidence that the recovery is leveling off. So yes, we went up in jobless claims, but not by that much. Yes, we went up in continuing claim, but it's more of a leveling off process.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
From New York City for our audience worldwide, good morning, good morning. This is Bloomberg Surveillance live on Bloomberg TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Farrow. Tom Keene, let's put TikTok on ice for 15 minutes, hey? And let's talk about the real story. A $2 trillion spread between Republicans and Democrats, and we're still on the road to nowhere.
Yeah, really busy first day of August here, John. Of course, unemployment report coming up, and that folds into Washington. As you mentioned, TikTok and NASDAQ 100 to the moon right now. We'll do that in a moment. But you're right, John. It is all-encompassing, this political battle in Washington. And I'm just going to go to the round number. John, how do you explain to 30 million Americans that there's not a check in the mail?
You can't, and that's the problem. Enhanced unemployment benefits expiring month end coming into August, Tom, and we're still negotiating, we're still talking. Lisa, maybe one thing that will sharpen the focus this week, payrolls Friday, the unpredictable payrolls Friday print, and I think the most unpredictable in quite a while.
You know, this is the conundrum. Politically, it makes no sense for them not to extend the enhanced unemployment benefits, and yet they are still negotiating. They have already expired. We're going to be watching talks that do continue today. Also, what I'm watching is just how big the deficit is going to get. The U.S. Treasury Department is going to be laying out their borrowing plans for the next 3 months and another expected record issuance of longer-term debt at a time the yields are near record lows, kind of an interesting conundrum here. And we're also going to be watching today President Trump, I am going to talk about TikTok. He is going to
give guidance I just think we should leave with something else. By all means, carry on.
I agree. He's going to give guidance on the fate of TikTok's U.S. operations either today or tomorrow. That's according to Fox News. And this is interesting from sort of a geopolitical tension standpoint, given the direct intervention. It's not enough to offload the U.S. operations, John. President Trump also is disclosing a discomfort with the idea of Microsoft purchasing the unit. And I think that will be something very important to follow.
We could talk about a range of things this morning. We'll catch up with Kevin Cirilli a little bit later in around about 15 minutes time. Let's get to the price action, kicking off the month of August as follows. In the equity market, equity futures on the S&P 500 in the last 30 minutes or so starting to lift higher, up about 16 points on the S&P 500. Your outperformance, though, coming from the NASDAQ. It is the Aaron Judge of the global equity market. Oh, there's more, Tom.
Get
there's
the
more.
watch out.
Don't worry.
Oh, my God.
Look at the dollar come back here. Unlike the Red Sox, euro dollar 117.31, down 0.4%. And all rise, the verdict is in. Growth is going to be soft through year end. $39 on WTI crude. Tom Keene, should we just go there and get it done with? Aaron Judge just crushing your Red Sox through the weekend. What happened?
I just put the banner into our people. Maybe they'll get up here. What happened here is talent. The first time I saw Aaron Judge, John, I was in rock star seats right down by the Yankee on deck circle. And what I'll never forget, besides just sheer size, John, is the way he moved. I have never seen a big guy move like that, with one exception, and that's that guy from the Netherlands that plays in the back of the field for Liverpool.
Van Dijk. Do you remember when you were a kid, Tom, about 10 years old, and you turn up to play sports with the older boys? That's kind of like Aaron Judge with everyone else in Major League Baseball.
It's true.
He's huge.
Well, there's other guys that are big, but the way he moves, folks, for those of you worldwide, it is something absolutely unique. John, why don't you bring in Dean Kernet here on these markets?
Don't worry, Tom. Don't worry, we'll move on. Dean Kernet joining us now, macro risk advisor.
2 minutes, 41 seconds into the show, and my manhood's gone.
Don't worry, I'm coming back again for it. Dean, great to catch up with you, sir. As always, the month of August never quiet. This month of August not quiet either. Why the calm, given what's happening in Washington at the moment?
I think it's the stimulus that's been pumped out so far, I think, has really dislocated the price action in markets relative to what we know to be a incredibly challenging situation on the ground. It's all coming to a head here with the negotiations between the Democrats and the Republicans, and it's going to be ultimately the pathway for the markets. Just given how substantially bad the backdrop is economically, the pathway for markets is going to be a political one, from my perspective.
I want to go to the heart of your expertise, which is the dynamics of the VIX. The VIX now is 25, and everybody's rationalized themselves that this is some new level. Do you buy it, or is the huge surprise of the next 18 months that we get a bull market and the VIX crushes back down to where it was in February of this year?
Well, we're certainly in a new regime of volatility. There was so much destruction of capital that had been almost permanent in markets in the post-crisis period, where selling volatility was extremely profitable for lengthy periods of time. A lot of that capital got wiped out, and so you have a new market clearing price for the VIX for volatility that's higher than it was. I'd also point to something else that's very unique, which is on the calendar is something in early November that's incredibly consequential for markets. And if you look at the price of, remember, there's a VIX, but there's also these VIX futures that trade. And if you look at the VIX future that's tied to the U.S. election, it's substantially elevated. It's not at 25, it's at 32. And that's the market expressing extreme uncertainty around the potential of a Democratic sweep, of a Biden presidency being pulled left, and the realities that the market may have to face up to something that's just not nearly as market-friendly as Trump has been.
That's in the future. In the here and now, I want to go to John's point, this idea that there seems to be an incredible amount of complacency at a time of incredible uncertainty. Are there parts of the market that you're seeing signs of unease, even after we saw junk bonds rally the most for a month since 2011?
Well, if you look at the cyclical parts of the market, that's where we've just not seen nearly the recovery. And I think that's, that's been consistent. There's a bifurcation of market outcomes right now. You've got the top 3 stocks in the triple Q constitute 35% of the entire market cap. It's without precedent. And what I would say is, ironically, it is in some of these high flyers where there's some discomfort being expressed, and you really wouldn't normally see this. So as these stocks levitate to all-time highs, the vol is traveling up with them. So you're seeing Microsoft, Amazon, Apple, certainly names like Tesla. As the stocks go up so significantly, the option prices, the implied volatility levels are rising as well. And there's some historical precedent to this, which makes me a little uncomfortable, which is the tech bubble itself. Difficult to compare anything to how outrageous the tech bubble was in terms of its magnitude, but you saw the same dynamic. I was just looking at Microsoft, the performance of the stock from, let's say, 98 to 2000, which was incredible. The stock had an incredible run. But the volatility traveled higher as the stock was traveling higher. And I just think it's the market saying, hey, this thing's getting more speculative. And I want to stay long this story. This tech story is so significant, but better to use the options than the stock. And so the demand for the options is increasing the implied volatility. It says to me that there's probably more to go in tech land, but this speculative nature of the rally has got me uncomfortable.
I didn't ask this question of someone last week. I'll ask it of you. Is it harder to rotate away from those names now, or harder to be long them at the ding-dong lows of March?
That's a great question. I think it's difficult in both circumstances. A little bit harder now. Again, the bifurcation is something that, you know, people use the S&P 500, for example, as a placeholder to be long. They also use it as the most obvious hedging instrument. And the reality is, beneath the surface of the S&P 500 are these dramatically different stories and performance profiles. And never before have we seen the leadership so substantial relative to, you know, the other things that are left behind. But I think, listen, being out of tech right now is a very challenging, it's a decision that you have to make on an active basis that, you know, puts the performance of your portfolio in substantial risk. And that's where, again, price defines behavior, and people are left long tech at increasingly lofty valuations, which is what's happening right now.
Dean, what do you think holds the keys to the divergence and therefore the convergence as well? Is it the Treasury market? Is it somewhere else? What have you got your eye on?
I think Treasuries are the glue to a lot of this story. If you look, for example, at the performance of the QQQ versus the KRE, the outperformance of that this year is just gigantic. And it ties back to lower rates. The one is the beneficiary of the lower rates. You can justify being long tech at increasingly lofty valuations when rates are so low. On the flip side, things like KRE, regional banks that are subject to loan losses, you know, smaller loan growth, virus outbreaks in different regions. This is proven to be, you know, on the short end of the stick in terms of KRE. I wanted to get to August as well, just really quickly.
Sure.
You know, we've mentioned that August is a bad month for markets, and I think that is the case. You know, you do have things like China in 2015. You know, you've got 2011 was the sovereign debt crisis and the U.S. debt ceiling issue. And now we've got this other political event for the U.S. My take is that this is in the realm of something that needs to be solved, because either side would take such a blow with respect to the outcome from people in terms of how they viewed whether the Democrats or the Republicans were supporting them. So it is this situation where they likely solve it. I know the differential is significant. And I think we're in for, maybe this is a little contrary, but I think we're in for a pretty sideways August. I just don't see the case for a substantial blow up in the next month or so.
Let's catch up in a couple of weeks, Dean. As always, great to catch up with you, sir. Dean Kerner, the macro risk advisors there to kick things off for the month of August. Tom, typically always volatile, especially over the last couple of years. But to Dean's point down in Washington, there is this faith in the mutually assured destruction for both sides if they don't make a deal on fiscal policy.
Yeah, I think for our listeners this week, as we go to the jobs report on Friday and with Mr. Kaplan coming up, is well, John, are these two competing stories. Right now, you've got NASDAQ to the moon, maybe off the Google ADT news this morning. Whatever, Apple, I've got a 431 on right now. It's going to be a $2 trillion company, John, before you exit to prepare for the open.
Maybe a couple of days away, we might be there, Tom, given the price action of Friday. Lisa, the data is already fading. There is already a huge debate on whether we will get a negative or positive print this Friday in the payrolls report.
Yeah, and frankly, there's a real disconnect between what we're seeing in the bond market with yields at record lows, and at the same time we have stocks rallying. At what point does this disconnect come to some sort of head with fundamentals mattering again, John?
Questions for a man at the Fed coming up on this program. Dallas Fed President Robert Kaplan from New York City this morning. Good morning to you all. Heard on Bloomberg Radio, seen on Bloomberg TV. This is Bloomberg Surveillance.
With the First Word News, I'm Ritika Gupta. Microsoft is trying to salvage a deal to buy the U.S. operations of TikTok. CEO Satya Nadella spoke to President Trump about how to secure the administration's blessing to buy the popular but besieged Chinese music video app. The president had floated the idea of an outright ban on TikTok on national security grounds. Now Bloomberg's learned the White House has given the companies 45 days to hash out a deal. The White House and congressional Democrats are still far apart on a new coronavirus relief bill. Republicans have proposed a temporary extension of the jobless benefits that expired last week. House Speaker Nancy Pelosi says Republicans are being condescending when they suggest the payment is too high and should be scaled back. The UK is reviewing its options for fighting coronavirus flare-ups. According to the Sunday Times, a London-wide lockdown is being considered if cases continue to spike there. Local government secretary Robert Jenrick says he's not aware of that plan, but he says restrictions imposed in northwest England show that the government will act when and where necessary. And the Japanese owner of 7-Eleven convenience stores has agreed to buy Marathon Speedway gas stations for $21 billion. 7&I is betting that an expanded U.S. footprint will deliver growth in the midst of the pandemic. Marathon is joining other energy companies in getting out of the retail business. And NASA has completed a triumphant return to U.S. space travel. SpaceX Dragon capsule splashed down into the Gulf of Mexico with 2 astronauts. That capped the first mission in which American astronauts flew to the International Space Station on an American spacecraft. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
This is Bloomberg Best, your weekly review of the most important business news, analysis, and interviews from Bloomberg Television around the world.
Ken Burns, welcome to Bloomberg Big Decisions.
We have always been a mixture of things. We are always stronger for that mixture.
Growth is a way to stay competitive, delight more and more consumers.
Welcome to the Best of Bloomberg Technology. I'm Emily Chang.
They've moved the needle by acknowledging that they have to monitor the content.
What is one word of advice you'll take with you?
Learn how to listen. And that is certainly something that has served me well.
Ankiti, where do you go from here? It's a huge market. It's a huge opportunity. I want to go 100x from here.
Our philosophy is to partner where we can and stand apart when we should.
Some things you see coming. Some things you don't. The trick is to be ready for anything. Pablo from Infrastructure Support is working every day to keep essential market data flowing seamlessly. We keep on, so you can keep on.
proposed a one-week extension at $600 so that while we negotiate a longer-term solution, at least all those people don't lose their money. And I'm surprised that the Democrats won't agree to that. They are insistent on having this as part of a larger deal.
Treasury Secretary Stephen Mnuchin on ABC this week. The Democrats will say, we wanted to start these talks months ago. From New York City this morning, good morning. Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Ferro. 2 hours, 12 minutes away from the opening bell in New York City. After 4 months of gains on the S&P 500, we kick off August with a morning of gains. Up 15 points on the S&P, we advance 0.5%. Here's the dollar comeback. Actually really interesting, given the dollar weakness over the last month. Euro dollar back down to 117.29. At one point on Friday session, we had a 119 handle, down 2 figures since then. In the bond market, Tom, a close at all-time lows on a closing basis. Yields are now higher by a couple of basis points to 0.55%.
I still note the deterioration in the 10-year tips, John, at negative 1.01 on the inflation-adjusted piece is just extraordinary. To help us with the many stories of Washington, Kevin Cirilli on a Monday, our chief Washington correspondent. Kevin, there it was, calendar item, beginning of August, as Republicans start to extract themselves from President Trump. A little itty-bitty article in the Washington Post about the strategy of Republicans after Trump. With this stimulus, how alone do the Senate Republicans feel?
Well, I'm struck by Senate Majority Leader Mitch McConnell really, allowing for there to be just a little bit of space and wiggle room between Senate Republicans and President Trump. And quite honestly, I think it's because he's looking at the map in the down ballot races for on November 3rd and looking to see how he could be able to hold together a Republican coalition. But it's quite striking when you hear Secretary Mnuchin on the Sunday shows over the weekend still not able to get to some type of short-term deal with Speaker Pelosi.
What's your timeline? What's the Cirilli x-axis of when this game of chicken ends for the Senate Republicans? Is it Tuesday at 11 a.m. or is it the silliness I hear about September?
Well, I think what you just said, the way you described it as a political game of chicken, is completely accurate. And a couple of weeks ago, I said that they might likely have to go into the first week of August, and that the intensity surrounding these negotiations would likely continue. So I think what everyone's looking for right now is for there to be some type of breakthrough with Speaker Pelosi and Secretary Mnuchin in the first half of this week to get to some type of movement beyond. However, I think back to the government shutdowns of predating the Trump administration back in the Obama years, and this could really drag on should there not be that sense of urgency.
Kevin, it's the ugly part of negotiations where it's a battle of optics and not a battle of substance. And on the optics, quite clearly the Republicans don't look good at the moment. They came to this late. They came with a bill late. They started talks late. And they're saying to the Democrats, okay, short-term extension. The Democrats are saying, we've been waiting here for months for you to come to us and talk. We want a long-term deal. At some point, though, the optics turn and the Democrats start to look bad for dragging their feet as well. How sustainable is Speaker Pelosi's position to say, no short-term deal, we want something long-term?
I don't think it's that sustainable, to be completely frank with you, because I talk with centrist Democrats who are scratching their heads and saying, we got to get to some type of approach here. They're not, as you just pointed out, they're not fighting. They are fighting over a host of different money allocations and whatnot. But right now, over the weekend, in the past 72 hours, the fight's been over process, piecemeal or a total package. And that right there, I think, is going to lead to some palpable frustration, because at the end of the day, there's a lot of Republicans and Democrats negotiating in leadership and in the administration, but there are a lot of rank and file members who don't even have any type of plan to sell to their constituents right now. And once those constituents are on the hook, whether it's the unemployment benefits or whether it's small and medium-sized business employees who are scratching their heads about a lack of certainty coming from Washington, D.C. and a lack of liquidity for their employers, that's when things are going to get really intense.
Kevin, as John was saying, the stimulus debate really is the main story in Washington, D.C. But then we have the side story of TikTok and President Trump potentially banning the company from U.S. operations. How much is this a real story? How much should we pay attention to this versus a distraction away from that main issue?
You know, I think in terms of a TikTok being a viable type of social media platform that impacts the economy and day-to-day use, not much. It's a bunch of youths, you know, doing the Macarena. However, I think the precedent that it sets, I think the precedent that it sets, Lisa, is that the administration, the U.S. administration, is willing rather to get into to big tech fights, and I think that, you know, as you look at this, and as I talk to Republicans and Democrats on Capitol Hill about a working coalition of nonpartisanship in terms of U.S.-China relations, this is just now one tool in the policy arsenal that America can utilize in order to impact, in this case, ByteDance, but in further cases, Chinese-backed businesses to really impact their access to the U.S. market, not just in terms of the supply chains and parts. We've seen that on medical, in the medical space, but also in the technological space as well. So yeah, I think the precedent is enormously significant as you look at the intensity of U.S. and China relations.
Everyone aggressively searching for the Kevin Cirilli TikTok account now.
I don't have one.
Kevin dancing
I don't have one.
Kevin, I think it's unprecedented to see this in a press release from a giant in the world of tech, from Microsoft. Microsoft appreciates the U.S. government's and President Trump's personal involvement as it continues to develop strong security protections for the country. This is exactly the direction of travel big tech wants Washington, D.C. to go in, to see them as part of the solution and not part of the problem.
Yes, and in fact, when I talk to sources at the State Department, when I talk to Democrats on the Intelligence Committee, they're looking at this and they're saying, you know, look at the 5G network that the U.S. has tried to really bulldoze through with Europe and trying to get Europe and Western allies back on board with the United States in terms of forming a coalition. So I think at face value, yes, it's an app that, you know, we can all make jokes about, but the strategy, Jonathan, I think that's what Lisa and you are tapping into, and Tom, I think the strategy behind it is really where the long-term significance lies.
You know, you're starting strong, Kevin, like the Boston Red Sox. It's time now for surveillance correction, and as Mr. Cirilli said, the Macarena. Lisa from Fargo emailed in and said, tell him it's the Renegade.
The Renegade.
It's the Renegade.
You are not. You did not just do that.
I did. We're talking about. Yes, I did, and I stand by it. But it is not the Macarena. Go ahead, John.
Kevin, run.
Surveillance correction.
I would like to.
Kevin Cirilli, thank you, sir. Down in Washington, D.C. More coming up on this a little bit later if you want to see more of Lisa's dancing on Bloomberg TV or on Bloomberg Radio. You missed out on a good one. I don't think you want to see it again either. Coming up on this program, Ethan Harris of B of A Securities on this economy and why Friday's payrolls report is so unpredictable. From New York City this morning, good morning, with equity futures up 15 points on the S&P. We advance 0.5% from New York. This is Bloomberg.
don't. The trick is to be ready for anything. John from Infrastructure Support is working every day to keep essential market data flowing seamlessly. We keep on, so you can keep on.
I'm David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
From New York City, this is Bloomberg Surveillance for our audience worldwide. We're live on Bloomberg TV and radio alongside Tom Keene. I'm Jonathan Ferro. Lisa Abramovich's degenerating over the weekend into an 11-year-old. She's back with us. She promises us she's older than that. We'll catch up a little bit later with Lisa about TikTok. In your equity market right now, up 16 points on the S&P 500. We advance 0.5%, 4 months of gains. We had some weight to it on the first trading day for the month of August. Typically a volatile one. It's quiet this morning. Yields up 2 basis points on a 10-year to 0.54%. Tom, keep talking about it. Dollar comeback. Euro dollar 117.32, 119 in Friday's session. Then we unwind some of that dollar weakness. The euro coming back down 0.4%. Payrolls Friday, Tom, just a couple of days away. I've got to say, it's a big one.
Hugely anticipated. I really can't say. Conversation to conversation, John, through the weekend and this morning as well, is gearing towards a Friday report, and then before that, the claims report as well. John, on the dollar, I think it's really extraordinary, the quiet that's out there. And, you know, some people, the strong dollar, the resilient dollar people, finally having their moment after 8, 9, 10 tough days.
HSBC, look, I always think it's too premature to see a 4 or 5% move in the dollar index. The dollar index, I might add, that's still north of 90. And to sit here and start saying it's the structural move you've been waiting for.
Right.
The reserve currency, the US dollar, we're moving away from it. It's just too early to make those conclusions, Tom.
Marvin Barth at Barclays agreeing with HSBC on the resilient dollar. Right now, to begin our week of economic coverage here on this simulcast on radio and TV worldwide is Ethan Harris. He's a Bank of America with authority on the transfer from Greenspan to Bernanke with this wonderful book, and also on absolutely nailing the non-V-shaped recovery of 2007, 2008. No major house did better than Bank of America on that call. Ethan, once again, we don't have a V-shaped recovery. What kind is it?
Well, we have a 2-month V followed probably by 3 months of L. That's what it looks like. And then hopefully from there, we start picking up again. But I mean, if you look broadly at the data, clearly the resurgence in the virus caused a little bit of pulling back in the economy in July, and we expect things to be kind of flattish for the next few months.
What is your unemployment statistic for Friday? I mean, people are verbaling a 10-ish%. How much of a mystery is that statistic?
Well, I mean, the employment report is going to be, could be anything. As we know, economists have done a terrible job of forecasting it in the last couple months, and that's because there's so much cross currents in terms of firing and hiring in the labor market. I mean, our guess at this point is the unemployment rate dips below 11%, so it comes down to 10.7. But to put that in perspective, that would be worse than any month during the Great Recession of 2008, 2009. So it's great that it's coming down, but there's still a long way to go.
Ethan, did you ever think that you'd have a payrolls guess of positive 1 million, but then also write in the line afterwards, there's a risk of a negative print? I mean, just how unprecedented is this moment for this payrolls report this Friday?
Yeah, I mean, it's a product of the unprecedented nature of the crisis. You have, companies that laid off, 20 million people, and now they're hiring some of them back. And the data we look at, that economists look at, that's supposed to tell us what these numbers are going to be, just doesn't really tell the whole story. And so we try hard. I mean, every economist is looking at these numbers over time, and we're still getting big forecast errors. So it's just an unprecedented time, and so unprecedented volatility.
Ethan, any seasonal quirks that we should be focused on going into this print?
Well, you do have a little bit of that. You've got, you don't have the usual shutdown of the auto sector in the summer, so that could help a little bit. We got payrolls coming in at 1 million. I think the consensus is a little higher than that, but those kind of smaller seasonal stories are overshadowed by, like I said, all the volatility in the number. I would view 1 million as okay. I mean, remember, payroll survey is taken fairly early in the month. So it's reflecting how the economy was doing in late June and early July. Things have weakened since then. So believe it or not, it's slightly old news. This July payroll number.
It's quite clear that the labor market is weakening, and there's faith that Washington will come to some sort of deal to extend the enhanced unemployment benefits. Let's just assume that they will come to a deal. Does it matter if they don't come to a deal in the next 2 weeks or 3 weeks? If it takes them a month, how big will the impact be on the economy?
Yeah, I mean, every week of delay, it gets a lot worse. I mean, these are not, the people getting unemployment benefits are on life support here. Their benefits don't expire entirely. It's just the $600 bonus. But that's been a lifeline for the unemployed and for the retail sector, which has done pretty well. Every week that passes that there's no extension is another week where they're cutting back on spending and getting a little more desperate. So the timing is very important. And I would hope that they don't cut them too much, that they cut them moderately. And I hope that there's more in the package than just that. The economy needs a lot of support right now. We're only halfway back to normal. We need a package that's about half as big as what we got in the spring. So it's got to be like $1.5 trillion, not $1 trillion. And it needs to be targeted well to the people who are most distressed. They're the ones who are going to spend money. So the size, the speed, the targeted nature of the package, they're all important. And right now, I'm quite worried.
Well, so you have fiscal hawks kind of coming back among some of the Republicans, and I have to wonder, not all deficits are the same. We're going to get a sense of how deep the deficit is going to be getting today when the Treasury Department releases their financing needs over the next 3 months. Can you give us a sense of how much lower the deficit will be, how much shallower it will be if there is a successful stimulus versus, say, not having a stimulus now and a slower growth trajectory going forward?
Yeah. Well, I mean, you have to pick your poison here. We're not gonna solve the budget deficit by cutting spending now. I mean, that's just risking driving the economy back into collapse. So there's a balancing act here. There's no choice. We either are going to have a bigger deficit because the economy's terrible, or we're going to have a bigger deficit because we're spending more money to support vulnerable parts of the economy. You can, on the margin, maybe reduce the deficit a little bit by cutting the corners. You certainly can reduce the impact on the deficit if you're smart about the way you distribute money. So, for example, these checks that they're being sent to households, these stimulus checks, most people who get those checks, unless they're unemployed, they're putting them in the bank. That's just a handoff from the government to the private sector. If you really want to stimulate activity and get a good bang for the buck, send it to the parts of the economy that need it. Send it to the unemployed, state and local governments, small businesses that are in distress. But these broader stimulus programs just don't work very well. We know from history that most of that money doesn't make it into the economy. It just goes into people's savings accounts.
Ethan, we're sitting here talking about policy risk. Arguably, we've already seen a policy mistake. These enhanced unemployment benefits have expired. What's the damage they will do to the early August data that we're going to see in the next couple of weeks?
Yeah, I mean, it's going to take a while to see it in the numbers. And each week that passes, it's going to get a lot more noticeable. Presumably, people have been getting this money because a lot of them are getting more in unemployment than they would have had they've been working. Hopefully, they've saved a small amount of it so they can kind of survive a week or two. So I don't think you fall off a cliff in terms of spending. I think you just kind of gradually weaken, and by the end of August, if they still haven't passed it, you're seeing a substantially slower consumer. We're talking about a weekly benefit of about $10 billion. That's, even for a big economy like the U.S., that's a big number. So it's going to be a kind of a sliding down in terms of activity, and those retail sales numbers that have looked so fantastic and really weathered the crisis well because the stimulus has been so strong for households, those numbers will start to fade as the month goes on.
And Ethan, if as the month goes on, is frankly unimaginable, whatever anybody's politics is as well. How do you adjust Q3, and particularly, how will you adjust Q4 GDP if we go along?
Yeah, well, first of all, we don't think there's going to be any real growth in the third quarter. Now, everyone's got a high GDP growth number for the third quarter, but that's because we ended the second quarter so strong. We had huge growth in May and June. And so the launching off point for the quarter looks high relative to the prior quarter, but we don't have any growth in our forecast during the quarter. We've just got basically flat activity with, as we see, a small pickup in jobs. So what you're going to do then is you're going to cut into that even more. It's almost impossible to get a negative GDP number for the third quarter, given that we start off at a higher level. But yeah, I mean, as you get into the fourth quarter, you're hoping that, you get a third quarter, maybe 20% pickup because of that effect of June on the data. You're hoping in the fourth quarter you get like a 5 or 10% growth rate. But, you could in the fourth quarter get a 0 if you, or even a negative number if you don't deliver at all in fiscal policy. Now, I think they'll deliver. We've seen this soap opera before, and once people start crying and really hurting, and then they come to a decision. And maybe it requires that the markets get a little bit upset because it takes too long. But eventually, I think they'll come to a deal. I just worry that they'll wait too long and it won't be well targeted.
Ethan, great to catch up with you, sir. Big week ahead. Ethan Harris there of Bank of America Securities. Just to offer you a flavour again of the payrolls report. Median estimate going into Friday, Tom, 1.5 million. The range already huge. 4 million is the highest estimate. That comes from a friend of this programme, Ian Shepperton over at Pantheon. The low is negative 500k. And Michael Gapin, another friend of this programme, Tom, over at Barclays, just throwing out a 0. 0. That's his estimate for this coming Friday. Gives you an idea of the range, Tom. Just wide, wide, wide.
I walked by the orbit of Michael McKee this morning, who's way better on this than I'll ever be, John, and he really emphasized the complete uncertainty into Thursday and into Friday as well. It's going to be eventful to say the least. John, I got to note, NASDAQ 100 futures through 11,000.
Outperformance on the NASDAQ once again. On the S&P 500, we advanced too. Here's the price action this morning, up 0.5% on the S&P. In the FX market, the dollar making a comeback. Euro dollar, 119 Friday for a moment. Right now, 117.29. And in the Treasury market, yields up 2 basis points to 0.55%. On Washington, up next, Sarah Bianchi of Evercore ISI from New York. Good morning to you all. This is Bloomberg.
With the First Word News, I'm Rishika Gupta. Bloomberg's learned that the White House has given Microsoft and TikTok 45 days to work out a deal. Microsoft is trying to salvage a plan to buy the U.S. operations of the wildly popular Chinese maker of popular music videos. At one point, President Trump had floated the idea of banning the app outright on national security grounds. Microsoft CEO Satya Nadella spoke to the president yesterday to try to get his blessing for a deal. Minneapolis Fed President Neil Kashkari is urging Congress to do more on the coronavirus and the economy. Kashkari told CBS the surging U.S. savings rate means the country can afford to support Americans who are out of work. He also said that a month to 6-week lockdown could lead to a faster economic recovery. And a warning from White House Coronavirus Task Force advisor Deborah Birx. She told CNN that the U.S. is in a new phase, saying the virus is extraordinarily widespread across rural and urban areas. Birx said that America is on the move during the summer vacation and the public needs to take more precautions. And Nobel Peace Prize winner John Hume has died. Hume was one of the chief architects of the 1998 Good Friday Agreement that brought peace to Northern Ireland. The deal ended the conflict amongst parliamentary groups and British security forces. John Hume was 83. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
fiscal policy actions that have been taken thus far have made a critical difference to families, businesses, and communities across the country. And it will take continued support from both monetary and fiscal policy to achieve that.
The Fed really can't stimulate the economy very much when people don't want to borrow and businesses depressed and so on. What they can do is make sure we don't have a financial calamity on top of the real calamity, which they've been doing very well and will continue to do. We need fiscal support.
It also is a very important step in dealing with inequality. Ultimately, inequality and the institutional biases that are baked into the cake of our economy.
I wouldn't be surprised if we did get the scenario Tom and I were talking about, that the market would just take over and drive interest rates into negative territory, even without the support of the Fed.
True diversification. That's what adding commodities exposure to your stock and bond portfolio can help provide. The Bloomberg Commodity Index is the standard for commodity market exposure. 23 traded commodities are represented: agriculture, livestock, metals, and energy. The Bloomberg Commodity Index is the benchmark most widely used by investment professionals globally. Track your commodity investments with a proven financial information partner. The Bloomberg Commodity Index. True diversification.
Does, as you say, have some catching up to do on that front. So we are expecting to see a little bit of strength coming through at the start of trade. How long will it last, though? The perennial question.
We're always looking, and we look at things through the lens of value. And we have to see a good portfolio fit, and so there are strategic screens that we look at for any transaction. We've got a pretty high bar.
Historically, we would worry about racking up too much debt. We're generating this savings ourselves. That means Congress has the resources to support those who are most hurting. Congress should use this opportunity to support the American people and the American economy. I'm not worried about it. If we get the economy growing, we will be able to pay off the debt.
Neil Kashkari there, Minneapolis Fed president on CBS Face the Nation from New York City this morning. Good morning to you all. Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Ferro. Tom Keene, don't worry about it. That's the message from the Minneapolis Fed on this bond market. This morning, yields higher, curve steeper, but your 10-year, Tom, 0.55% on a 10-year maturity in America.
Well, it shows the unusualness of the moment, and the unusualness of this moment, folks, in the bond market, and frankly, with the surging tech sector in the equity market, shows how unusual this election cycle is and the policy that is within it. Sarah Bianchi out of Harvard a zillion years ago has been a student of this for President Clinton and President Obama. She is with Edward Hyman at Evercore ISI and their acclaimed Washington research group. Sarah, there's like 8 stories to go on. John and I were deciding if we'd have you on for half an hour or for 40 minutes. We don't have that time. So I want to go to the stimulus, and I want you to gauge for all of our listeners the disarray of Republicans on Capitol Hill and Republicans down the street on Pennsylvania Avenue.
Well, there's quite a bit of disarray, and we always thought that this would be the most difficult package to get done, but I think it has exceeded our expectations, even in that regard. You have Mitch McConnell, who is trying to solve for really a divide in his caucus, some people who don't want to spend again. Some folks who I think even maybe are looking at November as a lost cause and trying to position themselves for Republican primaries. And then he's got on the other side people like Collins and the Colorado Senate race, people who need a deal here. The president, I do believe, wants a deal. I think there's just a bit of cacophony there as well with the chief of staff and the Treasury Secretary.
Okay, those are the minutiae. Let's go back to Harvard. I'm sure you studied Clash of Civilizations and Mr. Huntington. We have a clash of civilizations between people that think government in crisis has duty and people that inherently believe it's a swamp and it's government that it can't do it and is no good. Is that going to be business as usual forward, or do you actually see some form of new world for government out of this pandemic?
I think it's going to have to be the latter. If not, we're in real trouble because we've got some things that really coming up that only the government can do. How do you distribute a vaccine? How do you get this testing mess in order and help with supplies? So I think, what's going to happen when the UI rolls off? So I think this is, it's never easy in a democracy, but I believe that the American people understand right now that we're in a mess in part because our government didn't work well. And if it worked a little bit better, that we might not be in such a mess.
Tom touched on the fissures that we're seeing in the Republican Party. How big are the fissures within the Democratic Party as the liberal and the more center-focused areas of the party kind of try to hash out what they're okay with giving into with the Republicans?
Well, I think Pelosi and Schumer are very, very unified right now, and I think they have their priorities. They want to fix the unemployment. They really want the state and local government. They don't. They want some money for voting, and they don't want to give too much in liability. So I think they're fairly unified right now, but that's partly because they're in the minority in general in this debate, and it's easier when you are negotiating in a context like that than if they were running the show. I think it would be a lot harder.
Sarah, you mentioned voting, and I do want to go to November and the potential for some of the disputes following the election regarding mail-in votes. Given the fact that you've straddled both sides of private and public life, how big is election risk at this point? Do you think that markets are adequately accounting for the potential turmoil that's to come in November?
I think the potential is real. I'm not sure the markets are focused there. I'm not sure they should be at this point. However, I think the potential here is very high. We are a very divided country. I think even the Biden camp expects these polls to tighten, and some of these states are just going to come down to a number of votes, and they're going to dispute it.
Sarah, I got to ruin your morning. You've got Clinton experience. You've got Obama experience. Are you on the VP list? And if you're not, who's the most intelligent VP candidate for the vice president, Mr. Biden?
Well, I don't want to make any news on my shortlist status today. Now, you know what? The most intelligent pick for the vice president is who he feels the most comfortable with governing. He understands that this is a partnership. And
okay, great. Is that Susan Rice?
Yeah. I think you got to kind of be in those conversations with him to really have a feel for it. I don't know. It could be. I think he's got a lot of talented people that could fit well with him. Honestly, I think on this one, I just think unless you are in and around it, all speculation is just idle speculation.
John Farrell, Ed Hyman's going, Sarah nailed that.
Yes, very diplomatic, sitting on the fence. Don't say too much. Under pressure from Tom Keene. Sarah, thank you. Sarah Bianchi, Evercore ISI Head of U.S. Public Policy. Tom, it's an unusual one, isn't it? Because whoever the VP pick is, it's a potential 2024 candidate as well. That's what's really interesting about this one.
Absolutely, but John, it goes way beyond that. With the age of these two candidates, Mr. Trump and Mr. Biden, I've never seen this, John. I mean, I'd have to literally go back and look at the 19th century. Michael Beschloss, somebody like that would be smarter than me, but what I know for certain is this moment for both candidates is really something.
That's why you'd have to believe age was a huge factor in whoever the former VP picks as his potential VP. Just a couple of headlines crossing the Bloomberg. This from Senator Rubio, Tom, out on Twitter in the last couple of months. Let me read this one to you. On TikTok, the danger is that the data it collects is owned by a company that must turn it over to China if they want it. The answer is for it to be sold to a company not under the Chinese Communist Party's control. Who made this argument last week? Mark Zuckerberg of Facebook, who said the following: "We believe in values that the American economy was built on. Many other tech companies share these values, but there's no guarantee our values will win out. China is building its own version of the internet focused on very different ideas." Tom, who would have thought that Mark Zuckerberg of Facebook would provide the rationale for Microsoft to be able to buy TikTok? But essentially, that is what big tech did last week.
Well, yeah, but I guess they're buying it. I mean, I guess that's the distinction
Trying
here, is
to.
we're not taking it. They're trying to buy it. And you really, I mean, who negotiates for TikTok? Beijing or the private enterprise it is? There's a real mystery here.
Well, so far publicly, I understand it is the private enterprise that it is, Tom.
Yeah.
Should we leave that there and then come
We
back
should
and
leave
talk
it there
about it a little bit
because
more?
we butchered the Renegade last time out on TikTok.
Don't
and I'm told
put the camera
I'm way
on
behind.
Lisa. As you said,
it's
Tom,
like the Savage or
this is
something.
the
I don't know.
benefits
I
of
can't keep
radio.
up.
Just the benefits of
can't
radio.
keep up.
myself, John.
Just
I love you.
make it stop.
Radio, you're loving it right now.
From New York City, good morning. This is Bloomberg.
مكافحة العدوى تكون على أعلى مستوى من تعقيم اليدين بالنسبة للحجاج، لبس الكمامة، التباعد المكاني، التوعية الصحية لهم في الباصات وحتى وصولهم إلى الحجر المؤسسي بمكة المكرمة.
أنا لا أدري كيف أصف هذه المشاعر في قلبي. كما تعرفون أن هذا الركن من أركان الإسلام الحج، واختارنا الله سبحانه وتعالى أن نكون ضيوف الرحمن لهذا العام.
When everything around us, including the way we work and live, has been interrupted, uninterrupted service is peace of mind. Juzi from customer support is responding to a 500% increase in daily call volume, no matter what. We keep on, so you can keep on.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
stock market's become less and less representative of the real economy, and you still have arguably the greatest divergence between real economic outcomes and the stock market.
I don't think we're going to fall off again. I don't think it's a W-shaped trajectory. It's not going to be a downturn again.
What we're getting now is evidence that the recovery is leveling off. So yes, we went up in jobless claims, but not by that much.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
Good morning, everyone. Good Monday morning. Jonathan Ferrell, Lisa Abramowitz, and Tom Keene. Bloomberg Surveillance in the last hour. Lots of talk on this stimulus disaster in Washington. No question about that. Our interview of the day on the Fed coming up. Robert Kaplan, Michael McKee will be helping us with the Dallas Fed president. But what we've ignored, John, is the markets. And once again, based off news items, tech up.
Nasdaq futures outperformed. Tom, I would say look to the spread between Europe and the United States as well. Euro dollar 119 on Friday. Just how stretched is that narrative getting? That divergence between Europe and the United States this morning. Euro dollar coming back down to 117.24. That's a big conversation for the coming weeks. So many people being optimistic and constructive on the continent, Tom, and completely the opposite here in the United States. How stretched has that got in foreign exchange?
Risk on here after that blowout earnings of the Amazon, Apple, and that the other day. Futures up 19, Dow futures up 143, the VIX 24.94, and it's correlated over, Lisa, to full faith and credit, where with these shockingly low yields, actually today, a little bit of a lift in yields.
Right now, we're looking at search for yields. Perhaps today we're getting a little bit of a sell-off in treasuries. Hard to read into that given how low yields got. I got to say, Tom, I'm watching credit. I'm watching the fact that you're continuing to see this rally following the best month for riskier debt since 2011. And this comes even as we see a growing number of bankruptcies. Lord & Taylor, the oldest department store chain in the United States, filing for bankruptcy yesterday. How do we correlate? How do we get a sense of how the bankruptcies with the low borrowing costs make sense?
I'm so glad you brought this up, but I'd also note Men's Warehouse folks in bankruptcy as well, not the drama of Lord & Taylor, the oldest merchant in the country. John Farrell, this really goes to the mystery of the jobs report on Friday, and as we heard from Dr. Harris of Bank of America, there's never been a mystery like this Friday's Bloomberg Surveillance.
Well, there's three mysteries, Tom. One is the automatic rollover you expect after the mechanical reopening and the bounce you get off the back of that. We expect the economy to soften out. That's point one. Point two is what you've seen happen across the Sunbelt. The reopening wasn't as clean, as tidy as most would like. That disrupted the economy as well. Point three is what happens with policy. Policy right now, no agreement whatsoever. Those 3 points make it very, very difficult to understand the trajectory of this economy into year end.
Dr. Kaplan to join us here, of course, on the Fed, on economics and how it folds into policy. But right now in the markets, James Athey joins us. He's with Aberdeen Standard as their senior investment manager. We love having him on for a more holistic view of what's going on. James, how alone is technology here in its ascent?
I mean, it looks incredibly alone, doesn't it? If you look at the U.S. equity market, without scratching beneath the surface, the message you get is that, wow, you've had an amazing recovery. The equity market is not just priced a return to normality, however you describe that, but it's gone beyond. But when you just scratch a little beneath that surface, you find that a very small number of companies have absolutely dominated price performance and really are the only things which are pushing higher, almost regardless of incoming data, almost regardless of the economic environment that we face. And that trend actually is global as well. If you take the MSCI World and you take US equities out of that, you get a very different picture. And obviously, if you take tech out of US equities, you get a very different picture again. So it does seem that the market is saying that, virus or no virus, whatever the world we're about to face, it's not a bad thing for tech. Quite the opposite. Tech is going to absolutely dominate. Now, that completely ignores any valuation because already you see these companies, even the established ones, trading off phenomenal-looking valuations based on any past or forward-looking earnings metrics. But for now, the market's not really in the mood to be too concerned by that extrapolation. It is very much a narrative-driven story.
Well, let's talk about the narrative, James. You've heard several versions of this, maybe 20 versions of this over the last couple of weeks. The United States, US market's the only thing going for them right now. 5 big tech names. Go for Europe. Policy's better. We'll see some more compelling growth differentials coming out of the continent versus the United States. Has that narrative got too stretched, James?
Yeah, definitely. I mean, I would take some issue even with the narrative to that point, because realistically, the annualized decline in second quarter GDP for some of the countries within the Eurozone, you know, was absolutely astronomical. The US at 32.5% there or thereabouts.
I'm placing an order to buy euro at 117.29. Order placed to buy euro at 117.29. Okay.
That narrative further, which is to say we really were seeing what looked quite a concerning spread of the virus in the US, and we weren't seeing anything near the same in Europe. We've just had some early indications that maybe things aren't as under control as would be hoped in Europe, and you know, the extent to which that continues and gets worse will definitely feed back into that narrative.
James, the optimal way of playing this divergence and or convergence in the coming months, is it through equities, is it through FX, is it through the bond market?
I think FX is, I mean, the dollar, it was a quite dramatic period, really, of dollar weakness that we've seen from the peaks of the dollar at the back end of March. Some of that was just unwinding of all of the funding conditions following Fed's actions, and that makes complete sense. Latterly, it was that narrative that you refer to, I think, which was really pushing the dollar further and further down. But history says that that's actually quite a difficult narrative to maintain for any period of time, just given the nature of those two major economies, the Eurozone and the US. One's a big current account deficit country, consumer of last resort. One's a big current account surplus region, and their sensitivities to FX, therefore, are slightly different, and that makes a euro-dollar rally quite difficult, certainly difficult in a period where demand is as weak as it is. Just on a short-term technical basis as well, I think it was fair to say that, you know, things like RSI were making euro-dollar look incredibly overbought, and it's normal for markets to take a breather at that stage. Whether that then becomes self-fulfilling and self-fueling on the downside for euro, again, I think that probably goes back to virus data in the near term.
James, meanwhile, on the U.S. side, you've got the Federal Reserve pushing investors deeper into risk, the sort of search for yield at any cost. Do you think that that's gone too far? Is there anything that can disrupt that, given the willingness of the Fed to continue with their programs?
Yeah, I mean, has it gone too far? I mean, I've been thinking that forever and a day. It really isn't something that I've been feeling since March or April. It's felt like that this, you know, an investor willingness to completely ignore fundamentals, completely ignore the balance of risks, valuation metrics, that's just been with us for so long now. It's become part of the fabric, and, you know, that becomes self-fulfilling in and of itself. So I'm still an investor. I still am seeking to understand what risks I'm taking, how I'm being rewarded, and I think most pricing, when it comes to looking at yield across various asset classes, I think most pricing has definitely gone too far given the future that I'm expecting.
I mean, John, we can fold this in with Mr. Athey over to Mr. Kaplan of the Dallas Fed as well. I want to talk, John, about a small business, and by that I mean only 9,000 employees, and this is Spirit Airways, symbol SAVE, S-A-V-E. And John, these are the adjustments. I get it, the airline business is cratered. I get all that idea. But the bottom line is 20 to 30% furloughed speaks to that fragility out there as we go into the Friday jobs report.
And Thomas, that phrase we hate, right size. They've got to cut the size of the business, cut the size of the airline. These companies are starting to right size for the reality that things aren't going back to normal anytime soon. Something that's stuck with me for the last 3 weeks, Toms, is a quote that came from JP Morgan's Jamie Dimon when he said the following: "This is not a normal recession. The recessionary part of this you're going to see down the road. You will see the effect of this recession. You're just not going to see it right away because of all the stimulus." That's stuck with me for the last 3 weeks. What does the back half look like?
You know, I want you to go to James on this, John, but to me what's so important here, folks, is our focus on somebody that employs 800,000 people or somebody who employs 260,000 people. John Farrow, this is about small business like this airline company.
James, there's going to be more. And I think the big issue in the previous quarter is that we saw joblessness surge, but disposable incomes, they held up, James, and they held up because of fiscal stimulus. And so many people benefited from that fiscal package. The back half, this idea that we've seen off the big cyclical test, James, have we?
No, absolutely. In my opinion, absolutely not. I think, again, there's so much noise, and you describe it well. We've seen surges in some of the data series just because it's a mechanical fact of life. When you shut an economy, people are not going to work. We've started to work through that process. People are going back to work. But as one of your clips that you were playing just before I came on was saying, I think it might have been Mohammed Al-Aryan, we're starting to see early evidence that the recovery is flattening off, and you would fully expect that. The backbone of every single economic cycle is employment. That is the longest term indicator which trends alongside the economic cycle. And we understand why that is, because that's the nature of the cyclicality of an economy. As more people are put to work, they have more money to spend, demand goes up, employers, producers need to increase capacity, so they need to take on more people to do so, and that feeds off itself in a positive fashion. But we also know that feeds off itself in a negative fashion when jobs are being shed. And as you've already described, because of fiscal policy, let's not call it stimulus just now.
Long position open at euro, on euro at 117.29.
We think we understand where the limits of fiscal policy might be. Today, as we sit here, it feels like we're in a world where politicians, governments across the piece do not see that there are limits on the quantity of actions that they can take. And that means that if they're prepared to continue putting money into consumers' pockets, the impacts are going to be vastly different from what we would normally expect in the short term. What problems that creates for the long term, and the potential for huge moral hazards, huge deficits and debt loads to be serviced, that's a question for another day, but that's something that I think we do also need to consider at this juncture. So very tricky, very difficult.
Hey, James, the conversation will continue. Our best to the team. James Athy there of Aberdeen Standard Investments. In your Treasury market right now, yields up, curve steeper, up 6 basis points on a 30-year. Tom, I spoke to Bob Michael of JP Morgan Asset Management on Friday, and I said, what's going to cross the 1% line first, the 10-year higher or the 30-year lower? And he said, are you kidding? The 30-year below 1%. And then he went on to say he thinks the 10-year yield in America, nominal, not real, can turn negative. Negative nominal 10-year yields in America over the next couple of quarters.
This is the arch battle, John, and you and I have got these people lined up. Steve Major at HSBC, Gary Schilling has been, courageously brilliant for decades. But J.P. Morgan's really led on this under Joyce Chang's leadership. Jan Loeys wrote the definitive piece on this, and Michael's on that trajectory with him.
10-year right now, 56 basis points. Coming up on the program on the fiscal effort down in D.C., Leslie Vinger Murray of Chatham House from New York City this morning. Good morning. This is Bloomberg.
With the First Word News, I'm Ritika Gupta. Microsoft is trying to salvage a deal to buy the U.S. operations of TikTok. CEO Satya Nadella spoke to President Trump about how to secure the administration's blessing to buy the popular but besieged Chinese music video app. The president had floated the idea of an outright ban on TikTok on national security grounds. Now Bloomberg's learned the White House has given the companies 45 days to hash out a deal. The UK is reviewing its options for fighting coronavirus flare-ups. According to the Sunday Times, a London-wide lockdown is being considered if cases continue to spike there. Local government secretary Robert Jenrick says he's not aware of that plan, but he says restrictions imposed in northwest England show that the government will act when and where necessary. The Japanese owner of 7-Eleven convenience stores has agreed to buy Marathon Speedway gas stations for $21 billion. Seven & I is betting that an expanded U.S. footprint will deliver growth in the midst of the pandemic. Marathon is joining other energy companies in getting out of the retail business. And NASA has completed a triumphant return to U.S. space travel. SpaceX Dragon capsule splashed down into the Gulf of Mexico with 2 astronauts. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
This is Bloomberg Best, your weekly review of the most important business news, analysis, and interviews from Bloomberg Television around the world.
Ken Burns, welcome to Bloomberg Big Decisions.
We have always been a mixture of things. We are always stronger for that mixture.
Growth is a way to stay competitive, delight more and more consumers.
Welcome to the Best of Bloomberg Technology. I'm Emily Chang.
They've moved the needle by acknowledging that they have to monitor the content.
What is one word of advice you'll take with you?
Learn how to listen. And that is certainly something that has served me well.
Ankiti, where do you go from here?
It's a huge market. It's a huge opportunity. I want to go 100x from here.
Our philosophy is to partner where we can and stand apart when we should.
The Boston Symphony Orchestra presents BSO at Home. While you stay inside, enjoy a curated collection of archived concerts and behind-the-scenes stories from BSO musicians. BSO Homeschool provides lessons for music lovers of all ages. New performances and messages from musicians are added regularly. Enjoy these selections and much more at bso.org/at-home.
Been working on the strategic future of the company. We're long past the stockpiling phase now in North America, and what we're seeing is big shifts from category to category. So things like hand hygiene growing very quickly.
Just give you a sense of the real-time action, the 10-year yield tumbling now 11 basis points, so continuing in this knee-jerk risk-off feel.
They have a $200 proposal, which does not meet the needs of America's working families. And it's a condescension, quite frankly, because they're saying, really don't need it. They're just staying home because they make more money at $600.
Speaker Pelosi pushing back on ABC this week. That pushback will continue through this week. The blame game very much ramping high down in Washington. From New York City this morning, good morning to you all. Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Ferro. Here's your price action. The squeeze on the S&P 500 continues, up 0.6% on the S&P. Just in the last hour, Treasuries really deteriorating. Yields high by 3 basis points on 10s, up around 5 on 30, 0.56%. As we begin a new month, the dollar comes back as well. Euro dollar down to 117.24. Some broad-based dollar strength, Tom, going into some messy talks down in D.C.
Yeah, no question about it. And, of course, steepening of the yield curve as well. And, of course, we'll talk to Mr. Kaplan about this at the Dallas Fed here in a bit. Right now, we've been doing the markets here with James Athey. Let's get back to the moment at hand for this nation, which is 30 million people, unemployment checks, aid, however you want to put it, income substitution. It's evaporated. Leslie Vinci-Murray joins us with Chatham House out of London with a huge focus on the United States and the rest of the Americas as well. Dr. Vinci-Murray, frame for us the urgency now for any and all. There just seems to be we'll get through this in a week or two. Do they have a week or two?
No, I mean, you think about a hot August summer in the United States, 30 million people out of work, a lot of people still engaging in those protests and looking for that check and watching the numbers, right? The big story is the virus, watching over 1,000 Americans dying every day and no sign of relief, no sign of schools reopening, hard to imagine going back to work even if there were jobs. There's going to be very little sympathy on the streets of America for a Congress that can't get its act together and agree a new fiscal stimulus plan that includes a very substantial commitment to sustaining those unemployment benefits. But partisanship is the name of the game. It's come back.
Yeah.
That bipartisan consensus that we saw initially, it's gone. And so, but there's a lot of pressure on both sides right now to firm up some sort of package.
Leslie, history is just littered with this. Whenever the crisis fades, the collective will to do more fades with it. We're experiencing that at the moment, except the crisis hasn't really faded much at all, has it, Leslie? And this is the issue. What is Plan B down in D.C., and how close are we to them actually talking about it?
Well, I mean, I think you can't stress enough. There is no sign, and this is, watching this from London, it is extraordinary to watch America really drive itself down the rabbit hole of this crisis. Plan B is, we're hearing some reports that maybe the White House has a plan to step in. It's not clear what that would be. It clearly has to work with Congress. But the Democrats have a strong incentive to hold firm, to ask for more, to ask for a bigger package, especially as they can see, right? Donald Trump's polling, not holding up against his vice presidential contender. And so I think it's difficult to see the end in sight, but there's tremendous pressure to at least have a temporary measure, and that's what we may well see soon.
Leslie, there's the potential policy failure on not passing necessarily an extension to the enhanced unemployment benefits. There's also policy failure that I think is incredibly important to focus on, one that you focused on, that is the lack of a virus policy. And you said that the bottom line is there still is no national plan for the virus, for fighting it, so we need the stimulus. How expensive is it that the United States does not have a cohesive policy on fighting the virus?
We're seeing the numbers, right? You've seen the number in fiscal stimulus. You see the debates going on in Congress, but the story of ongoing death, ongoing rising infection in so many states, and people just not being able to function, right? Not being able to lead their daily lives. I think there was a period in which there was something novel about it. There was really a rally around the flag. And then we had a moment of, the George Floyd moment, which really, I think, in some senses galvanized Americans, brought them together, gave them a focus, and now it's getting long, it's getting expensive, and people are looking at September, right? They want things to begin in September.
John, this is so important to have Dr. Vinjamuri with us from London. It works, and John, you're nodding acquaintance with the city, and it's just real simple. Mr. Slack, representing the Prime Minister, begins to suggest a lockdown of London. John, that's first of all, is it doable, John?
This is a worst-case option. It was reported by the Sunday Times newspaper, Tom, a plan to seal off London. And let's be clear, we're not there yet. I want to emphasize that. But there's a narrative doing the round that the United States has a higher tolerance for infections than, say, the continent. And I think that narrative is just too broad for what is actually happening in Europe at the moment. On the continent, you might be thinking about Europe, the mainland. In the UK, Leslie, there does seem to be just as high a tolerance for some of this and to reopen and push further. The Prime Minister's backed away from that in the last week or so. Can you speak to what is happening in the United Kingdom at the moment?
There's a lot of pragmatism amongst the British population. You see some of the images of, people flocking to the beaches, whether it's in Kent or whether it's in Cornwall. But the reality is that most people are quite cautious. They're seeing that there might be more pressure, more shuttering, that there might be reversals. And I think the one thing that's good is that there is now some confidence that there's actually careful planning, A, B, and C. If that infection rate rises above a certain level, that there will be shuttering. There's still a lot of uncertainty, I think, around schools. They've said that schools are opening in September, that people are going back to work. A lot of uncertainty about how that actually works and what it will mean, especially in London, where you have so many people reliant on the underground, on public transportation to make that happen. A lot of people planning to stay at home. But it really, I would say, is a very different context from what we're seeing in the United States. People largely feel that the virus is out of their daily life, obviously, with the exception of the most vulnerable populations or people in elderly care facilities. But life is, not normal, but it's acclimatized to a new kind of normal.
Learning to live with it. Leslie, great to catch up with you. Stay safe, won't you? Leslie Vinjamuri there of Chatham House. This goes back to something Lisa has talked about repeatedly. Lisa, how do we reopen if we can't get the kids back to school? And it's not just a story for the United States. It's a story for the world at the moment.
I'm living it. I mean, first of all, what do you do with their time? Second of all, how do you focus on work if you have kids who are at home? You're trying to get them off their screens. You feel guilty about that. You want them to be educated. You don't have the bandwidth to do it, John. Big questions, and frankly, not getting a lot of answers from officials because they just don't know. It depends on the path of the virus.
Tom Keene just hands the responsibility over to Mrs. Keane, and then leaves the house just earlier and earlier every single morning.
John, what's interesting
Literally
here
2 a.m. this morning, Tom Keane enters the building.
It's a perfect time for jokes, except this is deadly serious.
Tom, I totally agree with you.
Nationwide.
1,000%.
What upsets me so much about this is the politicians of all persuasions seem to be disengaged from the benefit inequality of what we would do with technology
Well, especially,
and
Tom,
virtual
the
learning.
politicians with the wealth to get someone else to take care of things for them.
Yeah.
It's a very different equation. It always is. On this program, up next, Dallas Fed President Robert Kaplan. Looking forward to that from New York City this morning. Good morning. Heard on Bloomberg Radio, seen on Bloomberg TV. This is Bloomberg.
see coming. Some things you don't. The trick is to be ready for anything. Pablo from Infrastructure Support is working every day to keep essential market data flowing seamlessly. We keep on, so you can keep on.
The volatility in the first two quarters were quite exceptional this year.
Part of it is participating in the better market opportunities that have existed in the second quarter, and we do expect a normalization of that.
The situation out there is still very challenging and very difficult to predict, so we should never be complacent.
From New York City for our audience worldwide, this is Bloomberg Surveillance Live on Bloomberg TV and Radio. Alongside Tom Keene and Lisa Bravitz, I'm Jonathan Ferro. Here's the price action. 60 minutes away from the opening bell as we kick off August trading. Equity futures higher, much higher by 0.6%. A nice rally off the bottom in the last couple of hours. In the bond market, yields up by 3 basis points on a 10-year to 0.56%. And the dollar making a comeback, 117.25, euro dollar coming down 0.4%. In focus, a big payrolls report coming up this Friday. Ahead of that, an important interview with Bloomberg's Michael McKee. Hey, Mike.
Hi, John. And good morning to Robert Kaplan. He is the president of the Dallas Federal Reserve Bank, and he joins us on Bloomberg Radio and television from there. Good morning to you, sir.
Hi, Mike. Good to see you.
We'd like to start by asking about what you're seeing in your district. You've been at the epicenter of the latest COVID surge in cases. Yeah. What's happening to the economy there now?
Probably around mid-June, the sharp rebound we were seeing started to moderate and started to stall. That was coincident. It came at the same time and along with the resurgence of the virus. And so we saw cases increase. We saw hospitalizations steadily increase. That has started to moderate based on the numbers I see, the daily numbers I get. It started to moderate over the last number of days. But what you saw the state do is put in, and cities put in a backup or unwinding of some of the reopening steps, re-emphasize how important it is to wear a mask, and we saw some effect of that. But you're seeing a rebound that's stalling to some extent. That's what we're seeing in Texas.
Well, that caused you to do a rethink of your economic forecast. What do you see ahead for growth and inflation and unemployment?
Well, and because we were seeing it here and in a number of other states, it's still our view that will contract for the year at about 4.5% to 5%. It has been our view after a very sharp decline in the second quarter. We'd have very healthy rebound in the third and the fourth quarter. I think that rebound is more muted in the United States now. And it's caused me to think that the unemployment rate, if we don't do a better job managing the virus, the unemployment rate is likely to be above 9%, between 9 and 10%. So we've moved up our unemployment forecast. And so I think we've got a rebound, but it's much more muted than it was. And if we don't do a better job managing the virus, we're going to have lower growth and we're going to have a higher unemployment rate. And so I've been spending a lot of my time talking more about the virus than anything else because it's so critical to the recovery.
Well, the $600 extra unemployment bonus and eviction moratorium, they're gone now. First, has your staff modeled the impact of that on the economy? And second, should we expect a wave of defaults that might affect credit markets?
We have looked at it. And one of the things that's unusual about this downturn that we've just had is incomes have stayed relatively solid, and a big part of the reason is these unemployment benefits. And so we're normally in a downturn, you see a drop in incomes. We haven't seen that here. It's still my view that in some form we'll get an extension of unemployment benefits. So I'm quite hopeful that that will continue, but if it didn't, yeah, you would see a further weakening in the economy, and in particular because consumers wouldn't have as much money in their pocket to spend.
Any business people telling you that $600 bonus was keeping people from coming back to the labor force?
A lot of business people were telling me that, honestly. They were telling me that it was challenging to hire people. We've looked at a number of studies. We've done our own work. We don't see it as much in the data, but I can tell you I'm hearing it from business people. And so whatever the right answer is, I think you still are going to need to see extension of unemployment. It may be restructured to some extent from the $600, but I think it's important that we see an extension of it. And I think the increased incomes, while it may have made it hard for certain individual businesses to hire, it's helped create jobs because it's helped bolster consumer spending. So the net effect still has probably been positive for the economy and for employment.
A number of your colleagues, well, at least a number of epidemiologists joined by your colleague, Neil Kashkari of Minneapolis, say that we need another nationwide lockdown for about 4 weeks to defeat the virus, and that should be job one over reopening the economy. What do you think of that?
I probably have a somewhat different view based on my conversations, again, with epidemiologists locally and through the country, in that the epidemiologists I've spoken with, which has been widespread conversations, believe we could manage this economy and the virus and have the economy open if all of us wore masks. That's first and foremost, and then we need a good testing and contact tracing regime. But in particular, if we all wore masks, they believe it would substantially mute the transmission of the virus, and you would not need to do a widespread lockdown. And in fact, many of them fear if you did more lockdowns, if you still don't have good following of the healthcare protocols, the lockdown to some extent would be wasted. And so I think their advice is, be very careful about the reopening, enforce a widespread practice of wearing masks, social distancing. Now, there might be isolated or localized areas in the United States where the virus is become unmanageable, and they're going to have to take far more extreme steps like lockdowns. But I think we're going to have to learn to live with this virus. We're going to have to learn to re-engage in our daily activities, but still control the virus. But widespread mask wearing is essential to that. And I think it's probably the most important practice that maybe has been done unevenly. And we've lost an opportunity to recover and control the virus and grow faster.
We're speaking with Dallas Fed President Robert Kaplan on Bloomberg Television and Radio. Do you anticipate, President Kaplan, that the Fed will change its forward guidance perhaps as early as September and tie it to inflation running a little bit above 2% for a while?
I'll just speak for myself. I would not do that. We've already given fairly specific forward guidance in the form of our Summary of Economic Projections, the SEP, where we've made clear that rates are going to stay around the current levels for the next couple of years. I would far prefer, when we do give forward guidance in the future, that we tie it to our dual mandate, and particularly tie it to unemployment, along with making progress on inflation. But I myself would not be in favor of tying forward guidance specifically to inflation. I would not want to see us do that.
Old guys like you and me remember well, last time the Fed traded a little bit of inflation for lower unemployment, the Arthur Burns era. Are you worried at all that that might be a mistake?
The inflation dynamic is different now. Meaning, used to be as in the old days, as you say, when you had a very tight labor market and you were at or past full employment, you would see inflation. But the world has changed. The structure environment of the economy has changed with technology-enabled disruption, which has limited pricing power of businesses. That, along with globalization, has meant that the Fed has been able to run the economy hotter with more muted inflation. And so we've had to change the way we think about inflation, unemployment. And I've also been much more cognizant of underrepresented groups, lower educated, blacks, Hispanics, women with a high school education or less. By running hotter, we've been able to get these underrepresented groups back into the economy, back into the workforce. And I think that's been very valuable.
The primary and secondary credit market facilities have up to $750 billion available, yet you've bought only $12.3 billion in bonds. The Main Street program, you can buy up to $600 billion, but you've bought only $82 million so far. Why doesn't anybody want your money?
Yeah. So I've spent a good amount of time. For example, I've got a key role in the municipal finance program, where we have it's a $500 billion program, and we've put out, as you noted, a very small fraction of that. I think one of the features of the municipal program, the corporate bond program, is usage is not an indicator of the power of the program. Just by announcing these programs and making clear that we would help provide a backstop to these markets, you've seen a substantial rally and flow of funds into these markets to where the Fed pricing is less attractive to than market pricing, and the Fed hasn't had to actually purchase securities the way we might have thought. I think that's a good outcome. And I think the programs have served their purpose. On programs, on the other hand, like PPP, I think it's very critical that those programs got used. And on the Main Street program, I think over time, I think we'll want to keep getting feedback and looking at ways that that program can get more fully used. Because I do worry, as healthy as the financial markets are and as loose as financial conditions are right now, one place they're not loose is for small and mid-sized companies, particularly if they're in person-to-person contact industries. And the Main Street program, and if there's another round of the PPP, those programs are critical to helping those small, mid-sized companies get credit. And so I do think usage is important to look at there.
One visible aspect of what the Fed has done, at least according to investors, is the stock market. Do you worry that you're creating a bubble, however necessary your actions may be, but that it might...
I'm placing a stop on profit on euro at 117.31. So stop on profit for euro 117.31. It's right here. Okay.
Yeah, I think we'd be wise to be cognizant and concerned about the impact we have on risk assets. I think it's necessary, but I think it's very important that these programs have a sunset date, that the markets understand they're not going to go on indefinitely. I know we've just extended our 13.3 programs to December 31st, but I do think it's important that we emphasize these programs will sunset, they will lapse, because I think it's very important that these markets are able to function without Fed support, and I think the Fed support creates its own fragilities in the markets, and I think we should be very cognizant of that.
Can't let you go without asking about oil. Bankruptcies are spreading throughout the industry.
Well, position closed on euro, profit £200.
Gasoline demand in the United States has recovered now to, again, in the neighborhood of high 80s, 90% of a year ago. I've actually been surprised how strong demand has been, even with the resurgence of the virus. People are driving. They're not taking mass transit, and they're not flying, but they are driving their cars. I think, to your point, though, with the resurgence of the virus, the recovery in demand has stalled a little bit and is hovering around 90%. And at the same time, we've got all this excess inventory. You know, we had all this oversupply that had been built up because of the drop in demand earlier this year. And I think it's going to take till middle of 2021 for that excess inventory to be worked off. So you're going to have a very challenging energy industry and oil market probably for the next 6-12 months, depending on how the virus proceeds and how demand recovers, because we've got a lot of excess inventory and oversupply. I think it will begin to firm later next year, but in the meantime, you're seeing shut-ins. I mean, people who are producing, who shut in their wells. You're seeing rig count drop precipitously, and I think you'll see U.S. production fall from about 12.8 million barrels a day at the end of 2019 to, we'll end this year around 10.8 million barrels a day, a big drop. And that's even with reversal of most of the shut-ins. We're just seeing less drilling activity, and you're going to see, and you are seeing, lots of bankruptcies, restructurings, and stress in the energy sector.
You're the markets guy at the Fed. You worked at Goldman Sachs for a long time. The enormous volatility in the Treasury market we saw back in March, did that have to happen? Reports are it was caused in part by huge levered bets by hedge funds. Do we need significant changes? Do we need supervision of the shadow banking system?
Yeah, so I do think part of what happened in March, which maybe hasn't been talked about enough, is you had in March and in part of April a forced selling wave through many financial markets. There was a substantial amount of embedded leverage, whether people were leveraging treasuries as part of risk parity trades or other strategies. And part of what the Fed did is facilitate that deleveraging. But I think now that we've been through it, I do think it would be worth doing more study as to what was the role of embedded leverage in these markets, and what are the implications. And I think, again, it means the Fed just needs to be cognizant that financial stability considerations are sometimes hard to see, and they can build up. And then when you have a stress event like we had this year, you see it manifest itself. I'm also very aware when you mentioned the Treasury market, Treasury is not the natural component of a portfolio that maybe it was, because rates are so low. You might find that many people who used to buy Treasuries naturally as part of a portfolio will be buying other assets, gold, maybe other assets. So that'll also have an effect on the Treasury market that I think we're going to have to spend more time trying to understand.
Well, we'll check back with you and see what you've learned in a couple of months. Robert Kaplan, president of the Dallas Fed, thank you very much for joining us today on Bloomberg Radio and television.
Thanks, Mike.
Worldwide. And now I'll send it back to you, John.
Hey, Mike, great work, as always. Good to hear from you, and good to hear from the president of the Dallas Fed as well. 3 quick points here, guys, just to wrap things up very quickly. On enhanced unemployment benefits, the Dallas Fed president commenting on that and actually echoing what the administration has said, that anecdotally they're hearing from businesses saying that those enhanced unemployment benefits are making rehiring difficult, though he emphasized he does not see it in the data, and on a net basis, the economy will be weaker if the jobless aid is not extended. Point 1. Point 2, on forward guidance and state contingent forward guidance, i.e. do you tie it to, say, a threshold, unemployment, inflation, a preference there to tie forward guidance to the unemployment rate, Tom? And a third point on financial markets, and I think maybe the most controversial point as well, is that these programs should be allowed to sunset. Now, policymakers have to understand that investors are conditioned by how policymakers behave, and those programs have only recently been extended, Tom. And I don't think you'll find anyone in this market who believes those programs will sunset if they're going to disrupt market pricing, which I assume they will.
Well, there's no question about that. And the sunset programs, particularly in crisis, have been difficult. And I guess it defines, John, are we in crisis right now? You're not in crisis if you own Apple. You're not in crisis if you own Amazon. But, John, I would suggest that when everything is said and done, a huge part of this market hasn't participated, and they feel in crisis.
Lisa, your thoughts, please, because I know you're itching to weigh in on all of this. Tom, you should have seen Lisa through this interview. When we got to the credit portion of it on sunsetting some of these programs, Lisa literally itching to get in the conversation.
How can a program ever sunset if the entire market pricing structure hinges entirely on the promise of a Fed backstop, with actually Dallas Fed President Kaplan confirming this, saying it wasn't even the take-up in some of these programs, just as the promise of the backstop of the Fed. How can you justify buying a 30-year Treasury at 1% yields, 1.1, 1.2% yields, if you don't have the promise of a Fed backstop no matter what, Tom?
And that is the heart of the matter, where the yield market is. We turn now, after Mr. Kaplan, to Catherine Mann. Catherine Mann is at Citigroup. She is one of our most distinguished international economists, and what has been wonderful about her work from her days at MIT is she is someone with a sense of history. Dr. Mann, the simple reality for all of the Fed, all of the academics, and all of our viewers and listeners is we've never seen yields at this level. Do they damage the economy, and do they damage confidence at these low levels?
Well, there are a number of different factors here. I think that, you know, the bifurcation between the asset side of the economy and the real side of the economy is accentuated at very low yields, because you have the asset side searching for any strategy in order to get the return on the assets. That's where the leverage comes from. That's where the reach for yield comes from. And yet that doesn't translate, that financial market oomph that comes from the Fed is not translating into the real economy. And that bifurcation is even more apparent now than it's been ever.
And what is so important about this, folks, if you look within the theoretical model, Dr. Mann, the Hicksian ISLM model, the LM curve benefits the haves. Does all the fancy mumbo jumbo does it benefit the have-nots of American society?
There's always, bringing in the ISLM model on Bloomberg, that's, you're expecting your viewers to be pretty teched up. But there are channels through which the, low interest rates, et cetera, do benefit the quote have-nots. I mean, anybody who owns a house is actually benefiting right now. And, that still is a widespread asset holding in the United States. It is not everybody. There's no doubt about that. But that is an important channel. And of course, to the extent that the Fed is supporting companies that are still wearing a life preserver, because we're only in life preserver mode at this point. Everybody's treading water, hoping that the virus is going to go away or there's a vaccine. The Fed is providing a backstop for those companies, and they are still in the business of employing people. So that is also something that is the role that the Federal Reserve plays. But there can be no doubt that the concentration of wealth, the Federal Reserve's policies does benefit those who hold wealth, and that is very concentrated in the United States. But it doesn't have no effect on the have-nots. I mean, I think we have to be fair about that.
Catherine, rates have remained incredibly low, near record lows, at the same time that you see inflation expectations ticking up. And Mike Wilson of Morgan Stanley over the weekend saying that could actually continue to increase over time. Just a quote from him, he quoted Milton Friedman famously saying, "Nothing is so permanent as a temporary government program. This is potentially more inflationary than appreciated, which means that back-end rates can rise. Portfolios are not positioned for this." Do you agree?
Well, I agree that rates could rise, but I don't agree with Milton Friedman. The other quote that he's very well known for is, of course, that inflation is always and everywhere a monetary phenomenon. In other words, the size of the balance sheet, the credit growth that we've been seeing around the world, that is assumed by the Friedmanites that this is going to be inflationary ultimately. However, and the markets are not positioned for that. But the way the markets are not positioned, I think, is not so much that there's going to be inflation that's out of control, but there will be more inflation than the markets expect. There is a big gap between inflation expectations as measured by the market and inflation expectations that is measured by the way the market, the labor market and the product market work. In other words, Milton Friedman's view of the world is very macro. The way we think inflation works these days is about, can workers get wage increases in tight labor markets? The answer is pretty much no. Do firms feel like they can raise prices? The answer is pretty much no. So you don't have any inflationary impetus coming through those kinds of micro foundations of inflation. But the market pricing, the financial market pricing of inflation is way below way below 1%, really.
Dr. Mann, I've got to get in a question here on international economics, and I note your wonderful map behind you with Latin America over your right shoulder. What is the fragility right now of EM and particularly commodity-based and virus-affected EM? Do you find it to be early 90s critical condition, or is it better than we perceive?
There are a couple of different cross currents on the economies. One, of course, is the domestic COVID crisis, which is quite apparent in a number of countries in Latin America, and that's very negative for their economies, and of course, the death toll in the individuals. On the other hand, the dollar weakness is supportive of commodity pricing, and we have seen some improvement in commodity pricing, and that is at the margin beneficial for the Latin economies in particular. Now, we have to overlay on top of that, of course, that within these economies, even pre-COVID, there was quite a lot of differentiation in terms of the sort of the status and stability of both the political systems as well as the quality of economic policy. So there are really three factors that you have to weigh when we look at Latin American economies: the domestic policy environment, political and policy environment. Number two, the COVID, and then $3 weakness and implications for commodity prices.
Dr. Mann, thank you so much. Very valuable after comments from Mr. Kaplan. Catherine Mann, of course, with Citigroup. Lisa, I look at the mix here on a Monday, and we can talk about the market, talk about bonds and that, but the date calendar for this week is absolutely overwhelming, frankly, just like last week.
Well, and Friday is the key day, and that is the important date, and that is the jobless report for the month of July, where the gap between expectations is incredibly wide. Regardless, Tom, it is very clear that the labor market is weakening. Just how much and just what the response will be really remains to be seen.
Well, it's interesting to see, and as Lisa's following the tips there, negative 1.02. That's a wow statistic, Lisa, even with a little bit of a comeback. The inflation-adjusted yield is extraordinary.
Basically, it means the Fed's sitting on the Treasury yield, even as inflation expectations go up. At what point will people stop losing money or protest against losing money in Treasuries?
Well, I'm losing money because I'm triple leveraged, Lisa, and I know you're double leveraged on Amazon. Futures up 22, Dow futures up 157, NASDAQ to the moon, the VIX 24.76, and we all do this with a little more resilient dollar than what we were talking to Catherine Mann about. Please stay with us through the day on Bloomberg Radio and on Bloomberg Television. Good morning.
As it stands right now, we are seeing too many people, for whatever reason, attending work with symptoms. That just cannot continue. Otherwise, these restrictions will be in place for longer than they should be. And I'm sorry to say, we will see more people die.
When community transmission takes place, it is inevitable that it will find its way into the more vulnerable parts of our community, and the aged care community is certainly one of those.
Certainly, these are very challenging numbers. We're at a very challenging stage with this wave. There's probably not a country in the world that has gone through a second wave that hasn't found it particularly challenging. It has very different and complex elements to it that make it quite difficult to manage.
When everything around us, including the way we work and live, has been interrupted, uninterrupted service is peace of mind. Juzi from customer support is responding to a 500% increase in daily call volume, no matter what. We keep on, so you can keep on.
I'm David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
Does, as you say, have some catching up to do on that front. So we are expecting to see a little bit of strength coming through at the start of trade. How long will it last, though? The perennial question.
From New York City, for our viewers worldwide, good morning, good morning. The countdown to the open starts right now. With equity futures up 21 on the S&P, we advance 0.6% on the S&P 500. We begin with the big issue, and it's not TikTok. We're beginning August with unemployment benefits expiring and fiscal talk seemingly on the road to nowhere, resuming on Capitol Hill with Republicans and Democrats $2 trillion apart. Secretary Mnuchin taking aim at Democrats.
The president's very concerned about the expiration of the unemployment insurance. We proposed a one-week extension at $600 so that while we negotiate a longer-term solution, at least all those people don't lose their money. And I'm surprised that the Democrats won't agree to that. They are insistent on having this as part of a larger deal.
For a longer-term solution, take a listen.
We have to have this done. We're just, look, many of my caucus want our bill to go to September of next year or June of next year. What are we going to do, come back to the table and do this in 2 or 3 months again? No. Let's give this the courtesy and the certainty of some assurance that this support will be there.
Let's bring in Kevin Cirilli, shall we? Bloomberg chief, Washington correspondent. Good morning to you, Kevin. The blame game continues. I imagine it will continue for much of this week.
Precisely, and in fact, there is no clear timetable, Jonathan, in terms of when a breakthrough on this political stalemate might emerge. Now, I've been speaking with members all throughout the last week who really said that they were being built into having the expectations that this could be a prolonged fight, similar to what we saw several years ago during the Obama administration, during the government shutdown that lasted far longer than anyone had wanted. Now, in speaking with sources this morning, they are also noting that in terms of the timetable here, there is really no potential breakthrough because both sides, from a political strategist perspective, feel that they have the political capital to prolong this battle. Take a look at what the president's chief of staff, Mark Meadows, had to say on the Sunday shows just yesterday. He said yesterday was a step in the right direction, speaking about that meeting between Speaker Pelosi himself and Secretary Mnuchin. Our staffs are actually working today. We will be meeting again tomorrow, but I'm not optimistic there will be a solution in the very near term. And it's that point, Jonathan, that I want to bold underline, because that right there is the president and the White House saying they are ready for a long, prolonged battle. As one Democrat put it to me just recently, you'd have to go back to the Hoover administration to look to see just really the risk that people are playing with now, with benefits and evictions now set to expire.
Kevin, no one seriously thought that Plan A would get over the finish line. That was always the negotiating position. For the Democrats, their disappointment, quite clear and obvious, that the Republicans came so late with their negotiating position. And here we are in August, enhanced unemployment benefits have already expired. And I'm thinking about the Plan B, the compromise. Do we have any idea what that looks like at this point?
It would potentially look like there to be more funding for state and local governments. But just this morning, the president continuing to dig in on this point, only underscoring the notion that Republicans are prepared rather for a prolonged battle with Speaker Pelosi and Democrats. He's saying that the increase in cases and data in now traditionally conservative states is because of a success of the administration as it relates to testing, and he's doubling down on the notion for schools to reopen. I do also want to note that there was some interesting developments that we've been hearing about behind the scenes for quite some time, where Speaker Pelosi now in private meetings reportedly, according to the Washington Post, suggesting that she has frustrations with Dr. Deborah Birx, who then now has come out and said that she is really pushing back against that, but the characterizations and the infighting now boiling over rather in a very public way that could only undermine and make more of a short-term deal even that much harder to accomplish.
Kevin, given the news cycle at the moment, I wonder what this means for the announcement of former Vice President Joe Biden's VP pick. Do you think this delays things a little bit?
I don't think it delays things in terms of the timetable. And speaking with sources at the end of last week, they have been adamant that the presumptive Democratic nominee is still operating on a timetable of the first or second week of August. There was some chatter and some excitement in the Beltway that we could have gotten that over the weekend. Clearly, that didn't come out. But in terms of where that is headed, I think that everyone is eagerly anticipating that pick. And whether or not they're going to be able to do some type of joint appearance. That it would be incredibly rare if they were not able to do so. But traditionally, Jonathan, that is how this process works: is that the nominee gets to meet solo with the whomever the nominee chooses to be their pick. But you know, a lot of reporters are going to have a hard stakeout given the coronavirus pandemic situation in Wilmington, Delaware.
Kevin, stay close. Don't go too far. KPW's Brian Gardner weighing in on all of this and saying the following: despite the slow pace, we continue to expect that Congress will pass a bill, but chances are growing that it will not reach a deal with the White House until next week. We think the size of the Phase 4 bill is likely to rise. Brian, the areas for compromise, the scope for compromise right now, where is it?
I think it's on the unemployment benefit, the additional benefit that you and Kevin just discussed. It's on the funding for state and local governments, which the White House has pushed back against the House Democrats want. And then it's the legal liability protection for businesses that want to reopen and want to avoid getting sued as long as they follow some generally accepted principles and protocols of how to reopen and conduct their businesses. I think those are to me are the three major pieces of the Phase 4 bill.
Speaker Pelosi is keeping the heat on Republicans because they've come so late to the party to negotiate. Do you think that's a sustainable position at a time when the Republicans are now offering to extend that enhanced unemployment benefit?
Yeah, I think politically, I think Democrats have a stronger hand, and I think some of the things that Kevin was alluding to, statements by the chief of staff, I think kind of reflect posturing and trying to make the best of a tough hand. I think there are a number of Senate Republicans, especially and House Republicans as well, that are running in swing states that badly want a bill. They want to show that they are active and caring for the taxpayers and the American people at a time of crisis. They want a bill. They're also getting pressure from the Federal Reserve, who, with Chairman Powell telling Congress, go big. So I think the White House and the Republican hand is weak. I think Pelosi can hold out a little longer. Everybody can always overplay their hand, Jonathan, so that is a risk for her. But I do think she has, if you ask me whose hand would I rather be playing right now, it's Pelosi's rather than the Republican hand.
Yeah, I don't think you're alone thinking that either, Brian. Just thinking about things at the moment. I had a conversation earlier about mutually assured destruction. If Washington doesn't get a deal done, whoever's fault it is really going to suffer when the election comes around. And Brian, I just wonder, who is it good politics for to push back hard against enhanced unemployment benefits at this point, when we know the benefits to the economy and the benefits to consumption?
I don't think it plays to anybody's strengths. Maybe there are a couple of House seats that are held by hardcore conservative Republicans where their base really does not want a bill. They don't want any federal involvement at all. That's a small number. By and large, I think most of the lawmakers represent states and districts that want something. So I don't think it's in anybody's interest to be holding out on this too long.
Brian, just a final question on the VP pick. What are you expecting? And are you expecting it this week?
You know, it's been a moving target, Jonathan. So, you know, we're certainly getting close. I think Biden has to announce something soon because I think they have to get on with the campaign. And the longer this goes on, it just becomes a distraction. It becomes too much drama. So I think we're getting close. Whether it's this week, next week, it's tough to say. But it's certainly within the next 10 to 14 days, probably closer to that 10 number than the 14.
Anyone in mind, Brian?
I think, the list has kind of shrunk to 5. Since we at KBW follow financials, the name on the list that is of most interest to us and the stocks that we follow is Elizabeth Warren. Of the 5, that which would be Rice, Duckworth, Warren, Bass, and Harris, I think Warren is probably number 5 on that list. I just don't think politically she brings enough to the Biden campaign and brings in some problems in that she would really rile up the Republican opposition and maybe turn off some swing voters. So I kind of doubt it's her. I could be wrong, but I doubt it's her. But that's the name that would probably have the biggest impact on stocks, especially in the financial sector.
Hey, Brian, appreciate your time this morning. Great to catch up. Really important week ahead down in Washington. Brian Gardner there. Coming up on this program, escalating tensions between the United States and China as the Trump administration prepares measures against TikTok. We're speaking with Evan Brown, multi-head of asset strategy at UBS. From New York City this morning, good morning. With equity futures rallying ahead of the opening bell, this is Bloomberg.
Fiscal policy actions that have been taken thus far have made a critical difference to families, businesses, and communities across the country. And it will take continued support from both monetary and fiscal policy to achieve that.
The Fed really can't stimulate the economy very much when people don't want to borrow and business is depressed and so on. What they can do is make sure we don't have a financial calamity on top of the real calamity, which they've been doing very well and will continue to do. We need fiscal support.
It also is a very important step in dealing with inequality. Ultimately, inequality and the institutional biases that are baked into the cake of our economy.
I wouldn't be surprised if we did get the scenario Tom and I were talking about, that the market would just take over and drive interest rates into negative territory, even without the support of the Fed.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
The Boston Symphony Orchestra presents BSO at Home, a collection of concerts, at-home lessons, and behind-the-scenes stories to enjoy while you stay at home. Learn more at bso.org/at-home.
President Trump has said enough, and we're going to fix it. And so he will take action in the coming days with respect to a broad array of national security risks that are presented by software connected to the Chinese Communist Party.
Secretary Mike Pompeo saying the Trump administration is preparing measures against a range of Chinese software companies that could pose a risk to national security. This as Microsoft confirms its continuing discussions to buy TikTok's operations in the United States and several other countries. Microsoft this morning up by almost 3% in the pre-market. For more, let's bring in Bloomberg's Scarlett Fu. Hey, Scarlett.
Hi, Jonathan. Yeah, the clock is ticking here because the White House has given Microsoft 6 weeks to come to some kind of agreement. Now, aside from that deadline, nothing else has been decided. So the price, the terms, any kind of technology sharing or asset transfers are all subject to negotiations. And what's complicating matters is that there are essentially 3 parties involved in these talks. You've got the 2 companies along with the White House, which first threatened to ban TikTok back in June. Now, for Microsoft, buying TikTok would be a shot in the arm for its social media and consumer businesses. Its main exposure now to both those arms is through LinkedIn, which it bought back in 2016 for about $24 billion. And as you mentioned, it's not just the U.S. Microsoft looking to buy TikTok's operations in Canada, Australia, and New Zealand. As for TikTok, it has seen the writing on the wall. It faces accusations that it would hand over user data to Beijing, and it has tried to improve the optics as much as possible. It's hired a U.S. CEO, Kevin Mayer, formerly of Disney. It's also spent massive amounts of money on lobbying D.C. The bottom line here is TikTok wants to avoid being banned in the U.S. because it's seen what's happened in India after that country banned TikTok, and the business was devastated as a result. As for the White House, China hawks in the administration are definitely using TikTok as a flashpoint in U.S.-China tensions. The president, of course, looking for ways to hit back at Beijing for COVID-19 and for its crackdown on Hong Kong. He's also really frustrated with some TikTok users that have disrupted his campaign. But at the same time, the White House doesn't want to anger TikTok's 165 million users in the U.S. These are young voters who could potentially turn on the president in November. And what's interesting here, John, are the links between the two companies. TikTok's owner, Zhang Yiming, worked at Microsoft briefly back in 2008, and TikTok's general counsel is a Microsoft veteran. He worked there for about 20 years under the current CFO, who's going to be negotiating against him in the discussion. So we'll see if the familiarity leads to any kind of resolution sometime soon.
Scarlett Fu, thank you. Scarlett, thank you very much. What an important, interesting moment in Washington, D.C., and for the world of big tech. Big tech understands there are two hot button issues at the moment down in Washington. One is them, and the second is how to deal with the Chinese Communist Party. There is quite clearly an effort from big tech to make sure that they are seen as the solution and not the problem. We got a flavor of this last week in testimony from Mark Zuckerberg of Facebook. Take a listen to what he had to say when he said the following: "We believe in values that the American economy was built on. Many other tech companies share these values, but there's no guarantee our values will win out. China is building its own version of the internet focused on very different ideas." Who would have thought that Facebook Mark Zuckerberg would essentially provide the rationale to allow a company like Microsoft to buy TikTok? And what was interesting about the statement that came from Microsoft last night was something you don't see very often. This line right here: "Microsoft appreciates the US government's and President Trump's personal involvement as it continues to develop strong security protections for the country." This is exactly the direction that big tech wants Washington, D.C. to go in, to see them as part of the solution, the national champions, so to speak, not the problem. To continue this conversation, Evan Brown, UBS Asset Management Head of Multi-Asset Strategy, joins us right now. Evan, I know this is something you and the team are thinking about at the moment, and that's these two spheres of influence, China and the United States, and these national tech champions at the epicenter. How important is this moment for you?
It's a fascinating time, and I think you pointed out well, John, that it seems the only areas of bipartisanship in Washington are being tough on China and being tough on U.S. tech. So we're looking at where the relative skew of risks are, and as you say, these tech companies are trying to change the narrative a little bit and be the ones who can help in this scenario. It's unclear how successful they'll be. But in terms of the broader U.S.-China relationship, I mean, we do want to pay attention to this. There's a number of steps that have been, just countless steps that have been taken in the deterioration of this U.S.-China relationship. But at least right now, it hasn't devolved into something way more concerning on a macro level. We heard from Secretary Pompeo going after Chinese software companies. Software is a relatively small part of the Chinese market. It's really the hardware and U.S. exports of hardware that's really the concern. So far, we've been mostly focused on Huawei, but the U.S. is holding back on that side because it would just hurt U.S. tech companies too much. But other red lines that we're focused on, the potential for cutting off of dollar funding to Chinese banks, that is a clear flashpoint, and then potential escalation in Taiwan. So these are small steps that are building up, but right now they're not major macro issues at this point.
Do you see any investable opportunities either now or on the horizon off the back of this story, Evan?
I do. So I actually think that the risks to Chinese tech are probably exaggerated. We mentioned that Chinese tech, the mutually assured destruction of U.S. cutting off exports. I think the U.S. is just not going to move that fast in that direction. And I think people underestimate just how much the Chinese government will support Chinese technology and will support and how much of a captive investor base there is in Chinese tech. So there's actually an interesting thing here where any volatility caused by this recent disruption could be a buying opportunity for Chinese technology stocks, where I think there's a lot more negative news priced in, certainly compared to U.S. tech stocks.
That's the geopolitical disruption. Let's talk about the cyclical divergence that has become a huge narrative over the last several weeks. So many more people becoming constructive on the rest of the world versus the United States. Evan, from a cross-asset perspective, I just wonder for you guys at the moment, where you're more comfortable expressing that view and pushing it through, whether it's through equities, through bonds, or through foreign exchange at the moment.
Yeah, so for us, it's through foreign exchange, and I think we've seen that over the last month, where you've really seen the euro outperform, you've seen dollar weakness, but you haven't really seen European stocks perform. You haven't seen Japanese stocks perform, and it's just a cleaner play because you can play the relative economic performance through foreign exchange more purely, but you just can't forget the sector and factor weights of these various indexes. And the global economy is healing, but there's no vigor to that economic recovery. And we probably won't get that vigor until there's a vaccine. So how are these deep cyclical areas of Europe and Japan really going to outperform? So I think it's better played as an FX story, or you pick your spots within equities. So you can be underweight some of the more cyclical areas of the U.S., but you can't be strategically underweight U.S. tech for too long. We just saw that last week with these tech companies and their ability to put up the numbers that they have. But maybe something you can play. One trade we have on is say long European small caps versus U.S. small caps, where there's less of an underlying tech underweight than if you're playing against the large caps.
And Evan, just in G10 or EM for that matter, in foreign exchange, where are you more comfortable pushing that view through in FX? Is it through euro dollar? Is it through something else?
Yeah, it's true. Look, the euro's come a long way. We had one of the biggest monthly moves in history, so it's hard to say that that immediately you're going to get the same kind of momentum in the euro that we've seen at least over the last month or so. But that said, we can't forget that there's a big European investor base that has been underhedged in U.S. assets. And so there's a structural play here, not just a cyclical one. It's not just the cyclical outperformance of Europe in the near term due to relative handling of COVID, but it's just that you have now interest rates in the U.S. quite low, especially real interest rates relative to other countries. It's much cheaper to hedge. So if you're a large European investor and you haven't been hedging your U.S. exposure, you're now looking at the cost difference, and it's a lot less expensive to hedge your exposures. And we're coming up to the U.S. election, which comes with all types of broader uncertainties. So that, I think, is going to be a structural tailwind for the euro going forward.
Evan, great to catch up with you. Really, really thoughtful stuff, I've got to say. We've got to continue the conversation on tech specifically. Evan Brand there of UBS. Coming up on this program, the analyst action you need to know. That'll be next in our morning calls. And later, David Leibovitz, JP Morgan's global market strategist, joining us for the opening bell. And the markets right now, equity futures just off session highs, up 19 on the S&P 500. We advanced 0.6%. That narrative, Europe versus the United States, just how stretched has that got on Friday? A 119 handle. Very, very briefly this morning, 117.03, and we might break that and return to 116. We're down 0.6%. Dollar yen moving out, some dollar strength through much of G10. Dollar yen 106, spot 29 at 0.4% there. And treasuries yields higher. The curve steeper, much steeper, up 4 basis points on a 10-year to 0.56%. From New York City as we kick off the month of August this morning, good morning. This is Bloomberg.
This is a step in the right direction. Perhaps it's a harbinger for more changes in the future, like the completion of the banking union.
Minutes away from the opening bell in New York City this morning. A beautiful one here in New York. Good morning to you all. Up 18 on the S&P. We advanced 0.6%. That's the price action. Here are the morning calls. A look at some of the analyst recommendations on Wall Street this morning. First up from the team at JP Morgan, upgrading Kansas City Southern to neutral with a 169 price target. The analyst saying recent private equity interest has created a floor under the stock. We're up by around about 2.6%. Your second call, it comes from the team at BTIG, upgrading Expedia to a buy, a $100 price target. The analyst citing a compelling risk reward following its recent sell-off. That stock up by a little more than 1% in early trading. And your third and final call, it comes from the team over at Goldman. Goldman Sachs upgrading Merck to a buy, a 105 price target. The analyst seeing plenty of firepower for M&A with $45 billion to spend on the balance sheet. That stock is up by 1.71%. Coming up on this program, we'll hear from David Leibovitz, JP Morgan Asset Management Global Market Strategist. He'll join us at the opening bell. Ahead of the cash open, here's the cross-asset price action worldwide. Equities pushing higher in the United States. Equities up on the S&P 500 by 0.6%. Your outperformance, it comes from Europe. The DAX up by 2.4%. Helped out, no doubt, by euro that's weaker and a dollar that's stronger. A switch up the board. Euro dollar 117.05 on the brink of breaking back to a 116 handle after having a little visit of 119 in Friday's session. Coming up this coming Friday, the payrolls report. The median estimate 1.5 million. The range wide. There is a negative print that some people might be expecting too. More to come on that in the second half of this show. From New York, this is Bloomberg.
It's humbling and it's incredibly exciting in terms of anything that we've done, so far as a company. Florence isn't trying to trick you that she's a real person. Florence is saying, I'm a digital person, I'm here to help. Florence is digital, there is no judgment involved. So the lack of human judgment actually makes our digital people more approachable and potentially more helpful.
sense of the real-time action. The 10-year yield tumbling now 11 basis points, so continuing in this knee-jerk risk-off feel.
Equities on a hot streak. Equity futures up 20 on the S&P off the back of 4 straight months of gains on the S&P 500, up 0.6% on the S&P this morning. The Nasdaq outperforming, up 0.9%. Switch up the board in the bond market. Here we are. Yields up 4 basis points on 10s to 0.56%. Payrolls Friday just around the corner. And in foreign exchange, the euro weaker, softer, lower against the dollar. Euro dollar 117.11. The dollar stronger against absolutely everything in the session in G10 today. That's the cross-asset price action. Let's get you some movers and get back to the market desk. Here's Abigail.
John, well, it is Monday, and we have lots of M&A action to take a look at. First up, the shares of Marathon Petroleum are popping sharply higher. This on the news that 7-Eleven's owner is buying Marathon Speedway gas stations. This is the largest deal for 7 & I, and they are joining other energy companies, Marathon is, in leaving retail, and 7-Eleven's owner is paying $21 billion for those assets. As for Varian Medical Systems, the stock is simply soaring, up more than 20%. A Bloomberg exclusive bet Siemens Healthineers is buying Varian for $16.4 billion in cash. That represents a 24% premium, so the stock is pretty much there. The biggest deal, medical deal this year, and Siemens is interested in their cancer treatment. As for the biggest winner this morning, though, ADT up 56%. This on the news that Google is investing $450 million in the home security company. This is part of their plan to make smart home security products, and clearly ADT investors are liking that. And then follow through from last Friday's big story and the continuation over the weekend into today, the news that Microsoft is interested in buying TikTok's U.S. assets. The terms are being negotiated, and of course they have that September 15th deadline. Traders are taking it, John. They like that big tech story.
Abigail, thank you. 90 seconds into the session. Big tech outperforming. IT up by 1.4% on the S&P 500. The Nasdaq outperforming in today's session too. The S&P up by about 0.5%. The bankruptcies keep piling up. Lord & Taylor, along with Tailored Brands, becoming the latest household names seeking Chapter 11 protection. PGIM CEO David Hunt anticipating more to come.
Bankruptcies and foreclosures are now just starting, and those will roll through the next 6 to 9 months as well. This is going to be a slow road back, and markets and investors should begin to accept that more fully.
Let's get back to Scarlett. Scarlett, the household names keep piling up.
They keep piling up, and investors have accepted that retailers are especially vulnerable. You mentioned Lord & Taylor. It was sold by Hudson's Bay to a fashion startup, Le Tote, last year for $71 million. Le Tote and Lord & Taylor both filing for Chapter 11 protection. Lord & Taylor has about $140 million of debt that it needs to reorganize. As for Tailored Brands, which owns Men's Warehouse and Joseph A. Bank, sales have fallen every year since 2016 because of online competition as well as changing consumer tastes. Now, the national lockdown basically killed off demand for new suits entirely. As you can see, retail and consumer companies make up more than 1/3 of the bankruptcies this year. And the casualty list looks like my local mall directory, mid-range and high-range, right? Neiman Marcus, J. Crew, JCPenney, all filing for bankruptcy this year. It's obviously not just retailers either. You've got cyclicals from all different sectors struggling to pay their debts: transportation, telecoms, energy, and retail. Hertz taking the title for the biggest bankruptcy this year. It had about $25 billion in assets at the time of its filing. PIMCO says more firms will likely go under as policymakers wrap up their massive overall broad support. They're going to do more targeted measures in the coming years to come. And companies that are too highly leveraged or are struggling to adjust to the new normal post-pandemic will probably likely fall by the wayside and be allowed to fail. Now, in the meantime, those who can tap the credit markets are doing so. And we heard that from the banks when they came in with better than expected earnings for investment banking fees. Both high yield and investment grade issuances have been rising all this year. High yield, for instance, just closed out July with its best monthly gain since 2011. Yields fell the most on record. And John, a Bloomberg survey this morning found that about 8 investment-grade companies are due to sell debt this week.
The supply has been absolutely phenomenal over the last few months. Scarlett, thank you very much. David Leibovitz of JP Morgan Asset Management joins us now. David, it's got to be the biggest pain trade. The bankruptcies are piling up. Supply from credit has been absolutely phenomenal. We've seen records on many levels in many places, and yet credit spreads are tighter. The why? The Federal Reserve. David, what else?
So, I think that it's not only just the Fed, and the Fed is clearly, amongst the central bank community more broadly, the 600-pound gorilla sitting on the long end of the curve. I think that there continues to be an expectation here that the economic reopening process and the recovery is going to look more like a V than a lot of us in the economics community necessarily believe. And I think part of what gives a little bit of credence to that argument is when you look at what's happened to some of the high-frequency numbers, particularly in those states that have been hit by the second wave of infection, they've definitely flatlined, but they haven't necessarily rolled over. And so, the question then becomes, are we being a bit too pessimistic about this reopening process? Are we arguably going to get back to normal sooner than expected? And that, I think, is part of what's driving spreads tighter in conjunction with obviously very active monetary policy, not just in the U.S., but more broadly around the world.
Well, David, right now we're at 488 on high-yield spreads, closing out the week last week, coming into this week and the month of August. Answer this for me. What would drive wider spreads at this point?
So I think that there are a couple of things that would drive spreads wider. I think the one that's sitting front and center right now would be any sort of significant disappointment on the stimulus front. The economy still needs a lifeline here. It's not necessarily capable of standing on its own 2 feet, and so an underwhelming package out of Washington, hopefully this week, I think would drive some spread widening. The other big issue that we would focus on with respect to the level of credit spreads is really the direction that the labor markets take from here. You guys were talking about bankruptcies earlier, and there's a very tight relationship between the unemployment rate and corporate bankruptcy filings. And so if we begin to see the unemployment rate stall out, or as we learn more about the actual employment situation for a lot of these people who think they're temporarily laid off, if we were to even see the unemployment rate move in the other direction, I think that would really cause